consumer is being very purposeful in their spending.
Consumers just haven't been shopping as much.
This is a happy period for the consumer, but it is, again, a sensitive period.
If you look at the retailers that are sort of winning in this environment, it's those who truly are kind of giving back real value to the consumer.
Where there's newness and innovation, consumers are going.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City to our audiences worldwide, good morning. This is Bloomberg Surveillance. If you're wondering why your hosts look a lot better and have a lot more hair than normal, that's because we do and we are. Romaine Bostick here alongside Katie Greifeld, Jonathan Ferro, Anne-Marie Hordern, and Lisa Abramowitz taking the day off here on this Black Friday, coming off of the holiday day yesterday, Thanksgiving Day here in the United States of America. Katie Greifeld, I'm sure you're full, but I hope you're ready for it today because we got a lot to talk about.
You know, it was hard to be present during Thanksgiving dinner because I was just so looking forward to that 3 a.m. wake-up call.
I did not even go to bed. It was like waiting for Santa Claus just to get here. What other treat can we have than to come in at 6 a.m. in the morning and do this show?
I really can't imagine. I am thankful for this opportunity, and we have, you know, some interesting things to talk about. It is Black Friday, the state of the consumer. It's been a great month for equities, and we'll see how the rest of the year goes.
We are going to talk a lot about that great month for equities. I mean, we talk about, 5% gain on the S&P 500. You wouldn't know it given some of the sentiment that you're hearing about in the market today, and 26% on a year-to-date basis.
Yeah, no, it is amazing. Shaping up to be the second best month of the year, but we'll see how today goes. It's a shortened holiday session, but we are just about a tenth of a way from having the best month of the year. So maybe we'll get there today. Who knows?
Well, here is the lay of the land, 6 a.m. here in New York, 7 p.m. over in Hong Kong, 12 noon right now in Berlin. Asian markets have closed. Chinese markets higher on the day. Some weakness that we saw in Japan and South Korea. European markets holding their own, and U.S. futures now just slightly elevated here on the day. 0.3% on the NASDAQ and the S&P futures. Russell 2000 looks like it might lead the charge again. And a big part of that, of course, is Katie Greifeld, that big cyclical rotation that I think we've been seeing ever since the U.S. election on November 5th.
It really is interesting. I mean, there was some talk about whether we were seeing the Trump trade stall out in the equity market. It seems like it's coming back and then some this week. But then you take a look at the currency market and you take a look at the dollar having its worst week in quite a few weeks, since August, actually. So it's interesting, these different pockets of the market and what actually are the drivers. You can't paint with a broad brushstroke here.
And of course, the big drivers in the U.S. market are going to be global drivers as well here on the final trading day of November, heading into the final trading month of the year. We're going to catch up just a little bit later with Nolting over at Deutsche Bank to get his outlook for 2025. Nora Wittstruck over at S&P is going to stop by to talk about the financial impact of the incoming Trump administration, and Nadia Wiggen over at Svelland Capital going to talk about that OPEC Plus meeting, Katie Greifeld, that I know you were looking forward to. It's delayed. What are you going to do with the next 3 days?
It's a bummer. I had it on my calendar. I had my alarm set up. We're going to have to wait a little bit longer to see if they're going to delay what their production plans are. All
right. Well, someone who definitely had her alarm set earlier this morning was Vonnie Quinn. She is outside Macy's flagship store here in Midtown Manhattan, Herald Square, where you're keeping an eye on the kickoff to the Black Friday season. I thought everybody just bought everything online now, Vonnie. Are people actually outside in 30-degree weather here on November 29th?
Beautiful crisp morning for it, Romaine, and yes, they were. You just missed the big scrum going into Macy's. It opened about 2 minutes ago, and well, as you can see, the line is already gone in, so it's not like Black Friday's passed. Nevertheless, there were those customers that wanted to get those extra doorbuster deals, and of course those gift cards that Macy's give out to the first 100 customers at the beginning of the day. Now, don't let this fool you. We are going to see a huge, potentially record number of customers today across America. 131.7 million, according to the National Retail Federation. And 2/3 of those will be in stores, which is really fascinating when you think about it, because the cadence of Black Friday has been changing over the years. And as you say, you don't really need to go in store on Black Friday or really any day this weekend. All these deals are mostly available online. But those retailers, and we're talking about Target, Walmart, and all of the earnings season that we've seen, they are competing for those dollars. performed very, very strongly this season. And there are 5 fewer days in the holiday shopping calendar this year. So each of these retailers wants those boots in the door. And certainly this morning on a 35-degree morning on 35th Street, they got some of them so far.
Well, you make a good point, too, that this is a shortened holiday season. I've been complaining about it because I want to put up my tree, but have to wait until after Thanksgiving. But talk to us about what this means for Macy's specifically. Of course, Macy's came out with some early results. Also, the news that one of their employees hid up to $154 million of expenses. This feels like a company that needs some good news right now.
Right, Katie, it's true. There was that sort of mini scandal. Macy's is getting it under control, and we are expected to have full results from Macy's within the next 2 weeks before December 11th, they have said. Now, the stock has been suffering. It's down 20% this year. However, analysts are still quite positive on Macy's and suggest that the plan to return to sustainable growth from next year is on track, and the new CEO is doing his job. So, for example, it's concentrating more on the off-price platforms, Marketplace, Bloomingdale outlets, for example. It's also extending the refresh of 50 namesake stores across the remaining stores. And it did start to go ahead with closing those 150 stores that weren't so profitable. So there's a lot more in the works than just this delivery scandal. And bear in mind that $130 to $150+ million was part of a $4.5 billion expense for Macy's. So small in the scheme of things, but of course investors want to know that everybody in management is in control of their brief and that they know what's going on at all times with the dollars that consumers are spending and the dollars that are being invested in the company.
Yeah. All right. Well, it'll be interesting to see the results of this investigation and, more importantly, the results from the most recent quarter. And Bonnie, we're going to check in with you a little bit later to see exactly what you are actually going to buy us, me and Katie here, for Christmas. Just about 26 shopping days until Christmas Day. And Katie Greifeld, just a quick clarification. Nothing is stopping you from putting your Christmas tree up.
There actually is one huge obstacle, and it's my husband, who I hope is watching right now. But he's really militant that you have to wait until after Thanksgiving to play the music, to put up the tree. I disagree. The tree stands are already up, Romaine. Okay, I'm with you, Katie Greifeld. I think Christmas starts whenever you want it to start. In fact, a lot of people already looking past Christmas into 2025, providing outlooks for what investors should keep their eye on. Joining us right now this morning here on Bloomberg Surveillance, Nolting, Global Chief Investment Officer over at Deutsche Bank Private Bank. And Christian, we talk about this idea of the rally in 2024 that I think caught a lot of people by surprise, not just here in the U.S., but globally. And a lot of questions right now about how sustainable that is into 2025. What do you say?
Yeah, so first of all, I think if I look back at the beginning of 24, there were so many risks outside, and probably there was no one expecting double-digit growth or even in the 20s for the S&P 500 right now. So, of course, we have the same ideas and thoughts for 2025. And I think you cannot take out geopolitical risks. They are there. And even today, right, we are talking again about Ukraine, for example. But if I look at the earnings of the companies, if I look at the valuation of the market, we think there's probably some room to go. So we don't forecast another 20% plus year. If so, I have nothing against this, obviously. But we are forecasting, for example, S&P to end 6,500, which I think is still some decent upside from here.
There's one way to look at this market through that fundamental lens, even from a technical lens. You mentioned geopolitics. This is going to be a big wild card for next year and beyond, particularly with some of the ructions that we're seeing over there in China with regards to tariffs, here in North America, for that matter, with regards to tariffs. And I have no idea, Christian, what the heck is going on with European politics right now. How should global investors view that lens?
So, yeah, from that perspective, I think you cannot rule that out. But I think you need to think what kind of trends does that, let's say, comprise? What does it start? Or where do we go from there? So if we think through what we are seeing in the US, in UK, in Europe, in China, is a lot of more fiscal spending, or a high level of fiscal spending, I would say. I think given all of this, that should continue into 2025 as well. So that's one thing. That's also, I think, if you look through demographics, not so much in the US, but in Europe, for example, as you mentioned, that's all a little bit inflationary, plus tariffs also, I would say, are sometimes somehow inflationary. So from that perspective, we take this into account. That need not be negative for the equity side, although geopolitics could have higher volatility. But there would be some impact, we think, on the bond side. And that's why if you look at the 10-year treasuries, for example, we could imagine them to be a bit higher, maybe 30 basis points from now. So 450, we wouldn't be surprised to see that in a 12-month time horizon.
Well, Christian, I find that really interesting, this sort of disconnect between what you're seeing in the equity market and what you're seeing in the bond market. It feels like the long end of the yield curve isn't necessarily talking to the S&P 500 and vice versa. So 30 basis points, it seems like possibly the S&P 500 could continue to rally past that. But at what point do yields rise to a level where even the equity bulls need to pay attention?
Yeah, if you look even this year, right, the more we were closer to the 5% of the 10 years, I think the more nervous the equity market got as well. I think you need to also look at real yields to take inflation directly into account. And that was quite steady. If you see real yields rising substantially, I think that would also, even at lower levels maybe, impact the equity market. But there would be some correlation. And I think one thing, if I again look back at 24, we had a drop beginning of August, right? And then correlations between equities and bonds did work, and that was different to a 22-year, for example. So from that perspective, I think to look at the metrics at correlations, also for 2025, that could make a lot of sense.
And I do want to talk a little bit more about geopolitics, because one of the persistent questions out there is, how do you hedge geopolitics? It feels like if you take a look at risk assets, you take a look at the equity market, you get a 1% to 2% drawdown at most. Oil can't seem to hold a bid here sustainably. How do you think about geopolitics, and do you even bother hedging at this point?
Yeah, I can tell you one thing. I think the big things in the market is always what we call the unknown unknowns, right? If an unknown is known, and geopolitics, somehow you would say that's not news, but the outcome, of course, is unknown at this point in time. What you can do, what we try to do with the large clients, but also with the smaller clients here, is to say, okay, what is the impact of a tail event in the market? So something that really brings the market massively down, and you can hedge this with simple long liquid puts on indices. And that's what we do, I think, very successfully, because you don't need to hedge the whole portfolio. You need to be able to find out what kind of risk you want to take, obviously. And so maybe you can just hedge the tail, which is much more cheaper. And we do this with liquid instruments like long puts, as I was saying.
Do you have any concern, Christian, that we haven't seen more downside hedging in this market?
I think one reason why volatility in equities is so low and even lower than the bond side is that a lot of people do hedging. So I think that's nothing new. But you need to be consistent with it because if you say, I just hedged the first 3 months and then day one after this something happens, then it's wrong, right? So you need to say, what's my budget for hedging? What do I want to hedge? I.e. maybe only the tail of the portfolio. And I think then that's a valid strategy.
Christian Nolting over at Deutsche Bank Private Bank, helping kicking us off here on Bloomberg Surveillance here on this Friday morning. Black Friday. Katie Greifeld, I know you probably haven't done any of your Christmas shopping yet. I assume your husband's holding you back from that too. I have to tell you, I've done most of my shopping already.
That does not surprise me. One iota. You seem like someone who really gets ahead of things.
I try to. I should also point out that, I felt like I got a lot of solicitations in my email box from a lot of discounts all the way back in October. I couldn't pass it up.
Interesting. So you get those emails and you open them up and you actually look at them.
I do. I'm a sucker. I've also, bought, I think, a bridge over in Thailand, and there's some Nigerian prince who I've got to wire about $2,000 to at the end of the show. But before we get to that, we're going to talk about the Trump trade, and we're going to talk more importantly about some of those Trump policies, how you adjust as an investor, as an economist, and beyond. Nora Wittstruck over at S&P. She's coming up in just a second. You're watching Bloomberg Surveillance. Just about 26 days until Christmas, less than 50 days until the inauguration of a new president here in the United States. In the words, the tit for tat has already started. Mexico is issuing a warning to President-elect Donald Trump that his threat of 25% tariffs would cost the U.S. economy as many as 400,000 jobs and increase the prices for American consumers. Trump using the threat to try to combat the flow of drugs and undocumented migrants across the border, so says his transition team. Joining us now to sort all this out is Nora Wittstruck, Chief Analytical Officer for Governments at S&P Global Ratings, joining us here in Studio 5. Nice to see you. I hope you had a great Thanksgiving.
I did. Thank you so much for having me.
Whatever sort of respite I think the markets have gotten, they're going to have to really gird themselves for volatility when it comes to the political space. Already, this tit for tat, I'm kind of surprised. I mean, the president here hasn't even been inaugurated. The president in Mexico is still fairly new, and they're already going at it in a similar fashion that we saw back in 2017.
Yeah, I mean, I think our economists who released their updated forecast earlier this week did indicate that while very preliminary, we don't know what the president-elect's administration is really going to do with tariffs, but initially they are also looking at the fact that the sort of effective tariff rate would go up to 25%, which is up from 14% where it currently is. So we are watching that. They are watching that, and definitely.
Is there a way, though, to quantify the impact? I mean, Scheinbaum throws out the 400,000 number. It's hard to know exactly what that impact would be, but I think everyone can look at 25% versus what it is now, and you look at autos, you look at some certain commodities, and you look at a lot of other goods and services, and you would assume those prices are going to go up dramatically.
I think that could be absolutely true. As not an economist, I'm not really sure. And I think we're still watching how a lot of the details of tariffs play out. But, at the end of the day, you would think that higher tariffs could definitely sort of weaken GDP growth and weaken overall demand for products.
Well, part of the conversation about tariffs, of course, is the conversation about immigration. And Trump has made it very clear that he wants to halt the flood of migrants into the U.S. As he has said, there's concerns that there could be mass deportation. Talk us through the potential impacts that could have on the inflationary landscape right now.
Yeah, so I'll say that our economists indicate that labor supply, particularly from immigration, was up about 1.6% on average over the last couple of years. And as I think we can all remember, maybe some of our restaurants weren't operating at full staff right after the pandemic, or potentially there were some construction jobs that might have been, delayed as a result of lack of labor supply. So really, immigration has been a surprise on the upside for the economy and actually helped growth in this U.S. be about double what we thought it was going to be at the beginning of 2024. So it's about 3% this year versus about 1.5%. So I think it has helped inflation. It's helped the labor market become a little bit more loose, which has helped on personnel costs, particularly for governments and not-for-profit enterprises that we rate. And I think, there's a potential for us to return to a tighter labor supply market, and that will, in turn, probably return inflation a little bit higher.
It's interesting. Earlier this week, we were talking to Nouriel Rubini on ETF IQ. He's bearish.
I've heard, yeah.
Part of the reason he's bearish this time around, though, is because he thinks that, those policies, in addition to, supporting the labor supply, that immigration has also brought down labor costs. But you make the interesting point in your notes that tighter border policies, they could reduce costs for governments that have faced higher social service expenses. So there's a bit of good news in here.
That's right. I mean, what we think is that tighter border security could have some positive impact for, supporting credit metrics. There could be some, as we talked, some dampening of growth and higher labor costs. But, I think New York City is a perfect example. When there was a huge flood of immigrants coming in and asylum seekers, the cost for them was creeping up to about $5 billion, which was unplanned costs for them. They've now revised that forecast to be coming down to closer to $3 billion, still a big number, but definitely a lot less than it was. So there could be some, savings relative to those costs if there is a bit tighter border security under the Trump administration.
I'm curious about the implementation of this. There's been a lot of talk about how the president has the power through executive orders to do a great deal without necessarily relying on Congress. But we've also heard from some local government officials, whether it's governors or mayors, basically saying that they have, to some degree, a fail-safe to try to push back on that. Should I believe that?
I'm not sure. I haven't heard that, but that's a great point. It definitely, I think, there could be more state influence over overall policy objectives, and I think that's something we're watching, given the unknown of how the scope and implementation details will play out in regards to tighter border security.
All right, Nora, really appreciate you making time for us. Appreciate you making the early trip into the studio as well. That is Nora Wittstruck of S&P Global Ratings.
What else would she be doing on a Black Friday morning?
Hopefully just watching Bloomberg Television.
I think so. Thank you so much.
Yes, thank you. Have a great weekend when you get there. And speaking of politics in New York City, earlier this week, Bloomberg's Matt Miller and I spoke with former hedge fund manager and current New York City mayoral candidate Whitney Whitney Tilson about his top issues and his focus on crime and immigration.
But where we went awry, and this is really a great example of, my campaign as a lifelong Democrat running as a centrist Democrat against the radical left that is in a one-party dominated city like New York has sort of hijacked our city and taken us too far to the left. We passed additional sanctuary city legislation in 2018 that basically made it impossible for local law enforcement, if they, for example, arrested someone who committed a violent offense, let's say they're a Venezuelan gang member. This, in fact, happened last week. And it was the 7th time this guy's been arrested this year. And this is crazy. On his first arrest, local police should have turned him over to ICE, and they should have deported him on the next plane to Venezuela, obviously. And because of this crazy legislation that went much too far back in 2018, New Yorkers, it's contributing to the violent crime spike here in New York. So I'm going to roll back the sanctuary city back to the way it was, for decades, where, I have no interest in helping the Trump administration try and deport 12 million illegal immigrants who mostly have been here for quite a while and are hardworking and contribute to our economy and aren't committing any crimes. Let's focus on the dangerous ones and get them out.
How do you run as a Democrat then, Whitney? Because it seems as though that party on the left has dismissed the narrative that any of these immigrants cause a spike in violent crime. And yet, here in New York, you've definitely seen crime run unchecked. The police haven't really been able to do much about it. And the homeless and drug addiction problem seems worse than ever as well.
Yeah, it's a big problem. Only 37% of New Yorkers surveyed say that they believe their neighborhood is safe. That's down from 50% in 2017. And that is reflecting the reality that since crime bottomed either just before the first year of COVID, when everybody was shut down, sitting at home, crime has spiked back up. Nothing like it was when I first moved to New York 31 years ago. But it's definitely crime and disorder are up, and people are voting with their feet. We've lost 500,000 people, 6% of our population, the second worst of any large city in the country since the year 2000. So I agree with the majority of New Yorkers. The city's heading in the wrong direction, and that's why I'm stepping forward to turn it around and be a centrist, business-oriented Democrat like your founder, Mayor Bloomberg, was. And look what's happened to the city in the 11 years since career politicians got in and have been screwing it up.
And that was former hedge fund manager, current New York City mayoral candidate Whitney Tilson speaking to us on Wednesday. And part of his pitch, Romaine, was that currently he's the only business candidate in the race. He's been a lifelong Democrat, but in his words, the radical left have taken over. So he wants to take some of that back. I'm intrigued by his candidacy. I mean, this is always a good reminder. I forgot that Eric Adams was still there, but and I know that he's kind of intimated that he might run again. I'm not sure if that happens, but you look at this field and you ask sort of what the people want, and you think about how Eric Adams got elected a few years ago. A lot of his opponents were talking about social issues and other things, and he was over there in certain pockets of New York City trying to address crime. And that was effectively what got him elected. Some say that might have actually played into national elections that we just had 3 weeks ago. That's true. That was a big proponent of his campaign, being tough on crime. A lot would argue that didn't go exactly to plan. And it's interesting to see Whitney Tilson sort of take up that same messaging and talk about how he wants to make the streets safer, the subways safer. And, you know, we'll see if he can back that up. Yeah, good thing that you caught up with him. Of course, obviously, that will be a big topic of conversation as we get closer towards the primary elections next year here in New York City. Meanwhile, we go global once again. A close check on what's been going on in the oil space. Crude oil, Brent and WTI headed for a monthly decline, though some people say that the trend could reverse. Nadia Martin-Wiggen, director over at Svelland Capital, going to be joining the big program in just a second. You're watching Bloomberg Surveillance here on Black Friday. Happy birthday, Anna Faris. Welcome back to Bloomberg Surveillance. Romaine Bostic here with Katie Greifeld in today for Lisa Abramowitz, John Farrow, and Anne-Marie Hordern. A little bit too much gobble, I guess, that they had last night here. So we'll carry the torch for them. Under surveillance this morning is the start
of the holiday shopping season here in the U.S. Black Friday shopping is underway. The National Retail Federation saying 183.4 million shoppers, to be precise, will be looking for deals between now and Cyber Monday. And over 131 million shoppers are expected to shop in stores and online today alone. Are you one of them, Katie?
I'm not. I actually went to a Banana Republic on Tuesday. They're having 40% off cashmere. It was total coincidence, though. I wasn't thinking about sales at all, but turns out now's the time to go.
Did you get something?
I did.
Okay.
I got like 4 sweaters. But, I mean, you think about the relevance of Black Friday.
Yeah.
I was getting Black Friday deals earlier this week. Black Friday, it's more of a state of mind.
Well, that's what the joke is now. It's become, first of all, it's Black Friday week, and now it's basically Black Friday month. One interesting thing that I was looking at, and there's a great story in the Bloomberg terminal about inventory levels and why you shouldn't expect those 40% discounts, because a lot of retailers now are sitting on much lower inventory levels than what they were a year ago during the last holiday season, particularly at companies like Best Buy, Kohl's, Target, Lowe's, all sort of down, only by like a percentage or so, but they're not necessarily bloated with all that inventory that they have to get rid of.
Yeah, the inventory question is an interesting one. I mean, Target earnings were a great reminder that we're not completely out of the woods yet, that a lot of these companies don't exactly still have it down pat. So it'll be interesting, of course, to see whether any stories about that bubbles up during this particular Black Friday, and also what the breakdown is between in-store and online.
Absolutely. You know, there's been a lot of talk, too, about people stocking up on things because everyone's afraid that tariffs that could potentially go up under the Trump administration starting in January. That's going to raise the price of everything.
I'm sure Jerome Powell is watching and just loves to hear that, the stockpiling.
Well, buy your French wine now, buy your apparel now. Apparently, President Joe Biden, though, is trying to push back on President-elect Trump's tariffs threats. Biden telling reporters on Thanksgiving that he hopes Trump rethinks. Biden says he hopes Trump rethinks his tariff. I have to say that with a straight face. His tariffs plans, and that it's a counterproductive thing to do. Biden also warning of damage to relationships between Canada and Mexico. I appreciate that Biden's trying. Yeah.
And
do you think Trump's going to listen to him?
I don't know. You know, I think Trump was pretty busy at Mar-a-Lago. I saw Elon Musk was there, of course, seated at the table.
He has not left Mar-a-Lago, apparently. Does he not have a house anymore?
I am not sure. I think he has many, many houses and none in his primary residence. But in any case, it's going to be interesting to see what is actually being used as a negotiating tactic when it comes to these tariffs. Are we actually going to get 25% tariffs on Canada, on Mexico on day one? Or a lot can happen between now and Inauguration Day.
And of course, a lot is going to have to do with the contours of what his administration looks like. We already know some of the nominees, particularly on the economic and trade front. Not so sure any of those folks are going to be as willing to compromise as some folks would like.
Wasn't Scott Bessent supposed to be a moderating influence, though? You think about the Treasury Secretary pick and that big rally that we saw that, you know, some of Trump's most dramatic impulses would be reined in. I don't know if that narrative holds up.
Yeah, and it was kind of interesting, too. Of course, there was some optimism with that Bessent pick. Particularly, you saw that with regards to softness in the dollar. Remember, we had dollar strength coming out of the election, as a lot of people think Trump's policies will be inflationary. Bessent may be providing a little bit of a counterbalance, but overnight, we actually saw the Japanese yen breach that key 150 level as inflation data out of Tokyo, raising bets that the BOJ will hike its rates in December. The currency there, the yen, hitting the strongest mark since October, rising bets that the BOJ will hike and the Fed will cut, weighing on the carry trade. Remember the carry trade?
Vaguely.
Yeah, okay.
I know we freak out
I was
about
an expert on the carry trade for like 5 minutes.
Oh, we all were. Every like 3 to 4 months, we have to brush up and freak out about it, and then it calms down.
Yeah, all right. Well, Katie Greifeld, we're going to pivot now to what's been going on in the oil space. We've been seeing a lot of oscillations there, and a lot of that, of course, is tied to what's going on with Iran. We are learning that Iran today was expected to hold talks about its nuclear program with the UK, France, and Germany. The European Union set to mediate the meeting in Geneva. Joining us now from London is Bloomberg Iran and Middle East reporter Golnar Moldavali to talk a little bit more about what we know. Has that meeting actually started? And if not, when does it start? And more importantly, what should we expect out of it, Golnar?
Well, we haven't been given any timings on it at this stage, unfortunately. What we know is that Iran, on the deputy foreign ministerial level, will be meeting with officials from France, Germany, and the UK, the so-called E3 countries, in Geneva. And these are very preliminary talks about Iran's, not just Iran's nuclear program, but I think the focus will be on the nuclear program. But there's a lot going on with Iran at the moment in the Middle East, obviously. There's a lot of moving pieces in the background geopolitically, not least of all this ceasefire between Israel and Hezbollah in Lebanon, which seems very, very fragile at the moment. And the fact that Netanyahu, Prime Minister Benjamin Netanyahu of Israel, has said that the ceasefire in many ways allows Israel to now focus on Iran. So he said that now a number of times. He also repeated it, I think, either overnight or this morning, that he wants to focus on Iran. And the incoming Trump administration has also signaled that it still believes that, to quote Mike Waltz, Iran is at the root of all the problems in the Middle East. So there's a lot going on for Iran. And this meeting is going to be important in terms of the way that, I guess, the Europeans and the Iranians can air some ideas about how best to position themselves ahead of the incoming Trump administration.
Well, let's talk about the incoming Trump administration a little bit more. As Romain and I were just chatting about, I mean, obviously it's not even Inauguration Day. We have about over a month to go, and still he's making moves on the global stage. You think back to the first Trump administration and how it handled Iran. What can we extrapolate out for the second Trump administration?
Well, obviously the first Trump administration had massive consequences for the Islamic Republic. One of the biggest foreign policy set pieces of the Trump administration was the withdrawal and an effective dismantling of the landmark nuclear deal that was negotiated under the Obama administration. And obviously the reimposition of a very tough sanctions regime on Iran's economy. I think it's there's a bit of more of a mixed message coming this time, based on Trump's nominations so far. We have people like Waltz and Marco Rubio, who are obviously very hawkish on Iran. They're, broadly speaking, neoconservative. And that doesn't mark a massive departure, I think, from Mike Pompeo and John Bolton. But at the same time, we know that there are elements within the Trump team who are very critical and quite scathing of the Pompeo approach and want to see a departure from that. And we see that maybe in his decision to nominate Tulsi Gabbard, who's a staunch non-interventionist. And broadly speaking, I think we can call her even anti-neoconservative on some fronts. So there's a question mark over how Trump is going to assert himself in terms of Iran. But I think the mood music so far is that he is probably going to repeat that maximum pressure strategy in the beginning. And I think then it's up to the Iranians to an extent to see how they manage that, and if they can get an effective back channel to Trump that kind of circumvents those more hawkish neoconservative voices.
All right, Golnar Maltavelli over there in London, Bloomberg reporter for us, a closer look at those Iranian mediation talks scheduled to start today in Geneva, as we also keep our eye on what's going on in the oil markets. On the back foot once again on Brent and WTI crude as both benchmarks look to close out the month of November with a negative sign in front of them, down about 1% on WTI crude, fractionally on Brent crude. An OPEC Plus meeting delayed, and big concerns here about a Trump administration and its policies for the world. Nadia Martin-Wiggen joining us right now, director over at Svelland Capital. Great to have you here, Nadia. I do want to start off here with that OPEC Plus meeting was scheduled to start Sunday, being pushed back just a couple of more days. That may not matter, but what does matter is why. There does seem to be some infighting going on behind the scenes with regards to those quotas. What do we know?
Thank you for having me. Yes, I mean, the delay means that they are not all decided exactly what they're going to do. They've been taking a wait and see approach every month to see if they will be actually providing more oil into the market. And they leave it almost to the last day before the crude needs to start loading. I think importantly, when we compare versus the OPEC meeting last December, they didn't have an official communique. We had various delegates drip feeding information to the markets, and the market took it very negatively. We also had Angola leave OPEC Plus, and there was no comment. So the market was very disappointed in that result last year. So there's pressure on them to be much more united this year. And the outlook right now is tough because the majority of analysts see an oversupply coming next year, but then we see compliance has been weak within the producer group, led by Russia and other countries. And so they need to get everyone lined up.
Well, that's what I'm curious about here, Nadia, because you have to sort of look at this meeting through the lens of what could potentially happen in the U.S. next year. You have an administration that has basically promised to increase output. I'm not exactly sure how they achieve that, but that's what they've promised. So if you want to factor that into your forecast here, how much wiggle room do the Saudis and OPEC Plus, for that matter, as a whole, have to actually increase production at this stage?
Well, in our view, we don't think they need to increase production, especially when we look towards the month of April. Then we see a big oversupply coming in the second quarter. Things don't look that bad in the first quarter because we've come from a situation where we've drawn inventories this year, and the fourth quarter is outperforming expectations in terms of demand. So in that regard, it's not such a bad situation. What the U.S. administration is promising in terms of additional oil coming out of the U.S. at Svelland Capital, we see additional growth coming out of the U.S., probably 400,000 barrels per day year on year, which is not a huge number. But where the support is really coming from is on the natural gas side, because we've had a lot of associated gas that has been basically wasted and been loss-making, or you make $1 per barrel of oil equivalent. And now with higher nat gas prices, we see, and that infrastructure to export more LNG coming, we see that you could get $4 or $5 support on a barrel's equivalent basis, meaning that for a producer that produces both oil and gas, they can do more and produce more going forward. So that is part of the story, but it's also other producers, Guyana and so forth, that are really putting the pressure on OPEC.
And the UAE, for example, that increase in production slated to begin in January, so approaching quickly here. But we're talking about supply, and this has been a supply-driven market for so long. I want to talk about geopolitical risk, though. We were having this conversation with Christian Nolting at the top of the hour that it seems really difficult to price in a risk premium here. Do you see that changing any time in the future?
Well, if we start with where we were, right, the risk premium has absolutely pulled back in oil, and we see that the call skew is still there to the upside, but it's much lower than where it has been. Going forward, it depends, what is that view on Iran? Right now, Iran is very quiet. That's why the risk premium has gone away. What does the Trump administration actually intend to do there? When we look at the war escalating, of course, closure of Strait of Hormuz, that would be catastrophic for the world economy, and that would really escalate oil. But that is not a very realistic base case scenario at this point. When we look at the near term, even if Trump were to sanction Iranian oil more seriously, and the only way that could work is by really forcing and convincing China to no longer buy Iranian crude, which is not an obvious thing, not impossible, but it's not obvious that will happen. OPEC Plus has enormous spare capacity, so they can replace that immediately. When it becomes interesting is if Trump were to also sanction Russian oil and gas, because then that's replacing a lot. Or if we look at this tariff idea with Canada and Mexico, if he were to go forward with that, 25% tariffs on Canadian oil, Canada exports 3.8 million barrels per day to the US.
That's what I'm wondering about, because you think about what Canada's biggest export to the U.S. is, as you mentioned, it's oil, it's energy. What would it mean for Canada? What would it mean for the U.S. if we actually did see that 25% tariff enacted on the first day of Trump's new time in office? And we have just about a minute left.
It would be catastrophic to Canada, because although Canada has built additional export pipelines specifically to go through the west coast of Canada, they have commensurately increased production. And that is a production growth we see going into next year. Right now, they're extremely dependent on exporting through the US. And when that export line breaks, we've seen massive discounts to Canadian crude, topping $20 a barrel. So this is, in our view, really a negotiation tactic by Trump to make Canada work with what he wants to see. You know, that's on the drug side, that's on immigration, things like that. And so Canada has to find a solution because they're absolutely stuck. It would be catastrophic for US refiners, which means that gasoline prices would have to go up. Would he put tariffs on importing gasoline so that refiners can run? So it doesn't make sense as a policy, but as a negotiation tool, it does.
All right, Nadia, I have to leave it there. Well said. Great to catch up with you. Nadia Martin-Wiggen over at Svelland Capital. A closer look at the oil and energy market. Up next, a closer look at what's going on over there in Europe. Euro area inflation climbing. A lot of concerns about budgets over there in France and a broader Europe economic landscape in question. Vasileios Gkionakis over at Aviva going to be joining us in just a second. You're watching Bloomberg Surveillance. You're watching Bloomberg Surveillance here on this Black Friday. Let's get a lay of the land. Romaine Bostic here with Katie Greifeld. U.S. futures marginally higher on the day, 0.3% on S&P futures. You don't see it there on the board, but Russell 2000 futures up more than 1%, Katie. And this gets back to that idea of outperformance in the small cap and cyclical space. That has been the story for the last few weeks.
Yeah, we've been following it closely on open interest. I imagine you're doing the same on the close. To see the small caps be the big winner in these Trump markets, we'll see how sustainable that is if these inflation fears come to pass. The Fed can't move as aggressively. Time and time again, we've heard that would be pretty hard for these companies with those high debt loads.
And just a reminder to our viewers that this is a truncated session in the U.S. today. The cash markets do open at the normal time, 9:30 a.m. in New York, but they do close early. Stocks will be closing at 1 p.m. The bond market shutting down at 2 p.m. Asian markets already closed here with the Shanghai Composite up more than about 1% here on the day. European markets still going here fractionally higher with the stock 600 up about 0.1%. Meanwhile, we do want to turn our attention here to what could come out of the ECB over the next couple of weeks, with ECB President Christine Lagarde suggesting to the Financial Times, not to Bloomberg for some reason, but to the Financial Times, that the EU should negotiate, not retaliate, as fears grow of a possible trade war under a new Trump administration. Vasileios Gkionakis joining us right now over at Aviva Investors to talk about that and so much more as we take a closer look here at the economic conditions in Europe and, more importantly, how those economic conditions, Vasileios, could be affected by the incoming administration's policies here in the U.S. Let's start on trade. We went down this road before for 4 years. We kind of have a taste of how it could play out. Will it play out differently this time?
Well, I think it really depends on what is the current role that the tariff announcements are actually going to play. I think if they are used as a negotiating tool, I think you can be a bit optimistic in the sense that eventually there is going to be some sort of a negotiation breakthrough. But on the other hand, if you think of them as something which is a bit more structural, a bit more permanent in terms of a shift in industrial policy and global trade, or even if they're being used to finance tax cuts in the US, well, in that case, the actual tariff implementation is a real threat, and it would definitely dent European, Eurozone, global growth and trade.
And of course, this is a threat that comes at a time where there is some fragility right now in that broader Eurozone economy, independent of whatever's going on with the U.S. I am curious as to what the reaction function can be, whether on the monetary policy side or on the fiscal side, to try to buffer the economy.
Right. So I think it's a very interesting question. And we do have the precedent of COVID now as far as the fiscal policy is concerned. I think in general, more broadly, on a global scale, we've entered a phase in which, if you like, looser fiscal policy is considered more of a public necessity. So I think, and especially with the German elections, which are likely going to produce an adjustment of the debt brake, I think there is a real possibility that if we get negative shocks, they will be to a certain extent cushioned by a bit looser fiscal policy. As far as monetary policy is concerned, look, central bank's mandate is inflation. and inflation can play out differently depending on the scope, the size, the timing implementation of tariffs, as well as if there is retaliation or not. I think it's pretty difficult. One would think that if there is no retaliation, well, then the filtering through from weaker growth is going to imply weaker inflation. But then again, Schnabel made a very good point the other day, which he said that, look, if moving into more globalization produced disinflationary effect, it's natural to expect that a move backwards, a move away from it, is going to have a net-net inflationary impact. So therefore, I think there is a lot of uncertainty about the inflationary impact.
Well, let's bring this conversation to the markets. Like you said, there are a ton of big, important questions out there, including when it comes to tariffs, whether we see retaliation. But when you take a look at the bond market, specifically the bond market, what is your base case for how this all plays out?
You mean in the Eurozone or more broadly? Because
specifically
I think
in the Eurozone.
Yeah, well, look, there are a large number of parts that are moving in opposite direction. There is the pricing in of the expectations of weaker growth. A case in point was after the US election, we've had a significant move lower in Eurozone yields, which was quite the opposite from what we saw in the rest of the markets. Look, the way I think about this is that I think we will be in a period where yields are going to be slightly higher compared to what they were in the past, largely because there's going to be looser fiscal policy. But equally, in the case of the Eurozone, I think there is a lot of expectations built into ECB monetary policy easing. I mean, right now we have the terminal rate priced at about 1.7%. With an inflation of about 2%, that would imply that the real policy rate would be minus 0.3%. And historically, if you look at it, you have real policy rates in negative territory whenever you have a deeply negative output gap, which I don't think it seems to be the case right now. So I think eventually we're going to see a repricing higher of the ECB monetary policy. And this potentially is going to imply a shift higher in yields, especially at the front end.
All right, Vasileios, going to leave it there. Vasileios Gkionakis over at Aviva Investors, of course, looking ahead to that next ECB decision that occurs on December 12th with the expectation, Katie, that we do get the fourth cut of the year out of Christine Lagarde and company.
Yeah, we'll see if that comes to fruition. Interesting to hear Vasileios talking about the threat of higher inflation. It's a global phenomenon, at least when you take a look at the developed markets.
I thought we had all beat inflation. Wasn't there like a big mission accomplished banner? It was all over. We were all supposed to be moving on to the next thing.
We're all going to cut rates no matter what happens. And here we are, inflation moving a little bit higher both in the U.S. and in Europe.
It gets to a broader question, though, about the state of the global economy. And we talk about a lot of cracks that we've seen for quite some time. And the bifurcation between what's going on in Europe, what's going on in Asia, and obviously what's going on here in the U.S.
Yeah, and it's funny. So I anchor this show called Open Interest.
I've heard,
We like to ignore Europe and just kind of pretend that it's only the U.S. And if you take a look at the stock market, that's kind of how it is. The U.S. outperforms.
Well, the U.S. Stock market higher here in futures trading. Of course, a regular open at 9:30 a.m. and a early close at 1 p.m. for U.S. stock markets. A lot more coming up. Michael O'Rourke, JonesTrading, Judy Dempsey over at Carnegie, Jill Standish over at Accenture, and so much more. Happy birthday, Brian Baumgartner. Stick with us. Bloomberg Surveillance from New York.
The consumer is being very purposeful in their spending.
Consumers just haven't been shopping as much.
This is a happy period for the consumer, but it is, again, a sensitive period.
If you look at the retailers that are sort of winning in this environment, it's those who truly are kind of giving back real value to the consumer.
Where there's newness and innovation, consumers are going.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City for our audience worldwide, good morning. This is Bloomberg Surveillance. I'm alongside Romaine Bostick, Katie Greifeld here. Lisa, John, Anne-Marie, they're all gone.
Yeah, I'm not
just
sure.
Us.
Yeah, I'm not sure how they were able to get today off, and we got on. We are basically the anchors of this network. The Open and the close.
I know.
There's nothing in between, right?
We could have met in the middle. We didn't need to come here at 6 a.m., but here we are.
Yeah.
Of course, it's Black Friday, a big focus on the consumer today, as well as on these markets, Romaine. It has been an incredible month. It's been an incredible year. A lot of questions about what comes next.
And it's interesting, too, because we talk about this sort of election-induced rally here in the U.S. Kind of started before the election, but really picked up steam once Trump got that victory. That's waned just a little bit. I think people just kind of taking stock of things. We should point out this is the final trading day of the month, and there is a typically month-end rebalancing, which probably started a couple of days ago prior to the Thanksgiving holiday. But some pretty big gains that folks are sitting on, assuming that you got into this market at the right time.
Big time. For November, 5% higher. For the year, on a total return basis, up 27%. It is just amazing. We're going to unpack all of that with
How was your Thanksgiving, by the way?
It was okay.
Who came to your Thanksgiving dinner? Anyone famous? Because I was just reading that Donald Trump had Elon Musk by his side during the Thanksgiving dinner, and Sylvester Stallone. And Elon Musk said they discussed Stallone's 1993 film Demolition Man.
Did they really?
Which I would think of all the things I would talk to Sylvester Stallone about, all the movies that he's done.
Yeah.
Demolition Man?
That wouldn't be the top of your list?
Like, really?
Can't say that I've seen that one in particular.
I've seen it.
Have you?
Yeah.
Yeah.
I'm not sure I would ask Sylvester Stallone about Demolition Man.
I don't think.
Rocky, maybe?
Yeah, perhaps.
That was pretty popular
I think most
franchise.
people would start there and maybe work their way down. But
First Blood?
They do
Remember
things differently.
They drew First Blood.
That's amazing.
Yeah, there you go.
That's the kind of energy we need on this Black Friday. And
are you supposed to be introducing somebody?
I'm trying.
Oh, okay.
I'm trying. I'm working viciously to think of a segue here. But coming up, a great lineup. Michael O'Rourke of JonesTrading. We're going to talk about the Fed because when in doubt, the Fed will cut. That's his view. Jill Standish also joining us of Accenture. Black Friday spending, of course, the topic of conversation. Then we'll also be talking to Linnea Geiss of PDI Technologies on the record number of travelers this holiday season. Actually, this is supposed to be like an all-time high for Black Friday and Thanksgiving traveling.
Yeah, and it's kind of interesting, too, because you talk about the idea of airline fares still being elevated, a lot of concerns about the consumer and whether they're stretched and willing to spend on something that's discretionary, though I guess for a lot of folks, Thanksgiving travel is less discretionary and more a mandate, unless you're like us, where we just sit here in New York. And,
we had a good excuse. You know, we had to wake up early, get in studio, but for a lot of people, that's a staple. But in any case, let's, of course, talk about these markets because U.S. futures in the green. It's going to be a shortened trading day, but the S&P 500, nonetheless, on pace for its strongest month since February. Let's break it down now with Michael O'Rourke of JonesTrading. He joins us now. And Mike, we were just talking about the incredible gains we've seen this year, 27% on a total return basis. You think about last year, too, gains of more than 20%. Is this as good as it gets when you think about 2025? Is it possible that we'll get double-digit gains of this magnitude again?
I would be absolutely surprised if we did. I do believe it's as good as it gets. Right now, there is a lot of enthusiasm out there post-election because, everyone's hoping for, deregulation-driven growth, tax cuts. The glass is more than half full in most investors' eyes pretty much everywhere. So you wind up with a very expensive S&P 500. There are some very attractive groups out there because the multiple in the S&P 500, the expensive part is at the very top end with the big mega cap, $1 trillion market cap companies. So you have to be a little more selective. I think there's great investment opportunities out there, but I wouldn't be so much in the S&P 500 as an index itself. I'd look elsewhere. I'd look down and look for stock pickers to find those singular opportunities out there.
So you have to be selective in this market, but let's unpack that a little bit more because we hear over and over again that yes, this is a very expensive market. It's a very expensive S&P 500, but we also hear that valuations are a terrible timing tool. So how do you factor that in when you're evaluating this market, that expensiveness?
Yeah, I mean, valuation is a terrible timing tool because obviously if you sell an expensive tape, you usually miss out on gains. I think it's more about you have to look for those places that are less expensive and offer more value. Whether, for example, I still think the banks have had a great run here, especially post-election, but they've lagged this market for the past 2 to 3 years. And obviously, we had a minor banking crisis. So I think there's still more upside there. Something like energy has lagged. and there's still concerns, but valuations are, they're the most attractive sector in the market. So I think it's more about shifting or allocating new funds to those places that are just less expensive and not chasing the momentum in the broad tape.
I am curious, though, Michael, when we talk about chasing momentum and maybe something a little bit less fundamental, what do you think about just the general risk on appetite that we've seen with some of the more speculative corners of the market? You talk about that big run up that we've had in Bitcoin, still flirting with the 1,000 level, right now up 2%, back to 97,000, and a lot of other pockets of this market that I think people had kind of pushed to the side earlier this year for a variety of concerns. When you see those animal spirits come back out, what's the momentum driving that?
Well, I mean, the momentum is amazing out there. This is, to me, it's on par with 1999, 2000. I think you're looking at an environment where we've actually had high interest rates since the beginning of last year. So for 2 years now, we've had the Fed funds rate above 4%, right? But we still have had strong economic growth where GDP's averaged 2.9%. The Fed itself says we're at maximum employment. And then they've turned around and started cutting rates. And of course, you had the election. So you have all these bullish incidents coming, catalysts coming together at the same time, fueling these animal spirits. I mean, the MicroStrategy story is pretty impressive. Here's a company whose business model is selling stock and convertible debt in the capital markets to buy Bitcoin. And now you have other companies replicating that strategy. It's as long as the capital markets are open, they can continue to do that. But that's not really a business model. And it just shows you that the Fed wanting to cut rates, that they're asleep at the wheel, not realizing that there are multiple companies doing this, using the capital markets to buy Bitcoin.
Well, I mean, it's funny. I mean, can we just talk about that for a second? Because a lot of people derided what Saylor did when he effectively turned a software company into basically a proxy on Bitcoin. There's obviously, in hindsight, a lot of method to that madness, and the fact that he was able to basically borrow at next to nothing interest rates, and then, of course, leverage that out for some pretty phenomenal gains. That last time I checked, has made this the second best performing stock in the Russell 1000. Why can't that be replicated? I mean, as crazy as it sounds, I mean, it worked for him.
Oh no, it can absolutely be replicated. That's my point. That's how financial conditions are. How easy they are. There are other companies out there doing that right now. There's probably at least 10 I know offhand that are following a Bitcoin treasury strategy. And companies go out and do at-the-market offerings. They sell stock into the marketplace, and then they turn around and buy Bitcoin with it. So it is happening. It just shows you how easy financial conditions are. And you have a Federal Reserve telling you they don't know where the neutral rate is, yet they want to continue to cut rates. So, like I said, I think the Fed's asleep at the wheel. They're missing what's going on in the equity market and financial markets, and that liquidity is abundant out there. So, right now it's very easily replicable. The problem is when the markets aren't as buoyant, that's when you run into issues because that's your funding strategy.
Well, we'll talk about the more serious stuff and, what it means that the Fed is asleep at the wheel. But I want to talk a little bit more about crypto because you talk about how other companies are replicating the MicroStrategy model. You think about the U.S. government. There's talk of a Bitcoin strategic reserve. This is the purest supply and demand market. But it sounds like you're looking at this skeptically. This isn't necessarily making you a crypto bull.
No, I mean, I still... Beyond, it's funny, you look back at Warren Buffett's 2011 letter and his comments about gold. For the most part, this is an asset that's not an income producing asset. It doesn't make anything, doesn't grow anything, So it's a speculative asset that you're just betting on people paying more for it. Of course, they've done it. It's worked. It's been a great trade. But beyond that, I have a hard time identifying, how do you model, the cash flows from something like that? Other than you're betting on, price appreciation and people paying higher than you are. I don't think that's speculation. I don't think it's investing.
Yeah, well, yeah, you're right. Michael, we're going to have to leave it there. Michael O'Rourke over at JonesTrading, and, of course, that phenomenal run that we continue to see in Bitcoin. Katie Greifeld, I know you've been all over that. Gold, actually, having a pretty good run, too, up 29% in the spot prices on a year-to-date basis, which I think anyone would take in any year. Not quite Bitcoin levels,
yeah,
but
physical Bitcoin. That's what we're calling gold now.
Physical Bitcoin, is that what we're calling it? Now, were you a Bitcoin person at some point, and then you became not a Bitcoin person? What happened to you?
I spent a lot of time on television and in print writing and talking about Bitcoin.
Yeah.
It's an interesting space to cover. I wouldn't, call myself a huge believer.
Yeah.
And it's certainly not my day job. I do think crypto is interesting just in terms of, I don't know, I just look at it as the purest risk appetite. It's a great way to actually measure euphoria in the market. And you take a look at Bitcoin, it can't seem to break around 100,000, but it's getting very close. And I think that tells you a lot.
And there's something more there this time around. I mean, we talk about a year ago when, you were seeing Sam Bankman-Fried paraded off in handcuffs and everyone thought the Bitcoin trade or the crypto trade overall was over. You look at the rally you've seen in stable coins. And then, of course, now everyone euphoric because the Trump administration promises to be a lot friendlier to this industry than the current Biden administration.
That's the thing. You can't really ignore it. You think about all the people who are pro-crypto who were elected into Congress. You think about Donald Trump himself. I don't know if he's a true believer, but he certainly says friendly things about crypto, about Bitcoin, and we're going to get a new head of the SEC. We'll see what happens. You have to pay attention, for better or for worse.
This is always my time to brag about how that time, years and years ago before anybody, I bought 2 Bitcoins for the low price, $90 for both. That included the fees.
Yeah.
I sold them at around $200, and I thought I was the smartest human being on the face of the planet. And now here I am, still working for Bloomberg Surveillance.
On Black Friday.
6 a.m. in the morning. 7 a.m. now.
Yeah.
Even better. I'm finally starting to wake up. Where's the camera?
I don't know. It's spinning around.
They spin it around here. This whole thing. It's like a circle here, right? Our normal thing, we're just in what is it, like 2D? This is like 3D? What is this?
You got to pay attention. Got to be on your toes. At least we don't have to stand up. I do like that part. But in any case,
I wore my good shoes today, though.
That's true. Coming up, Russia. We're going to go around the world here. Russia gearing up for a new round of strikes on Ukraine. At a time where American support seems uncertain, we'll bring you the details next. This is Bloomberg Surveillance. All right, welcome back to Bloomberg Surveillance. We are a little over 2 hours away from the start of trading on this Black Friday. You take a look at markets right now. Green on the screen. The S&P 500 up about 0.3%. The euro gaining some ground here against the dollar, but pretty muted, still holding above 105. You take a look at the bond market, a bit of a bid coming in, sending 10-year Treasury yields down about 5 basis points or so. Currently camped out around 420. I remember when we were at 450. It feels like a long time ago. And then you take a look at crude, paring some of its losses right now, but still down about 0.2%. Meanwhile, we take a look at the geopolitical landscape because Russia is targeting Ukraine's power system in a new round of airstrikes. It's the 11th time infrastructure has been attacked in the country this year and comes at a time where the future of American support for Ukraine's resistance is uncertain. Joining us now from Warsaw is Bloomberg government reporter Piotr Skolimowski, and talk to us about the context here. Of course, this would be the 11th such attack, but Putin specifically is warning about striking decision-making centers. Just how big of an escalation would this be?
Indeed, so we're seeing quite an escalation of the conflict since in the past few months, especially or weeks actually, especially since the election in the U.S., where we had got some clarity on what's going to happen next, and we're seeing both sides are trying to get as much of an upper hand before we get to the inauguration day. Well, what we've seen in the last few weeks is definitely an escalation in terms of U.S. has decided, or Biden administration has decided to provide Ukraine with more weapons. They finally decided to allow Kiev to strike targets inside Russia using Western-provided weapons, and these are ATACMS, and these are also UK-provided Storm Shadows. And that led, as we said, to a certain escalation where Putin last week deployed his new type of ballistic missile, hit one of the targets in Ukraine. And we heard yesterday from President Putin this morning that he is ready to, and he's looking at the potential targets where decisions are being made. Obviously, the importance of this new missile that he deployed is very clear, is that this is a type of weapon that can actually have a nuclear payload. And we already saw that last week the parliament in Kiev was evacuated because there was a fear of this kind of attack. But clearly, it's putting Ukraine at the back foot at this point.
And with regard to the nuclear fear, with regards to that, not only a nuclear payload, Piotr, but the idea here that if you use enough of these bombs at once, even without the nuclear payload, the potential damage could have a similar effect as a nuclear attack. Is that correct?
Exactly. Obviously, that's the major concern at this point. And obviously, when we still talk about this new weapon or this new missile, it doesn't seem like Ukraine has air defenses that are capable to stop it. So that's where the concern is. But what we've seen over the last few days, what you've mentioned, it was 11th attack. We're talking about missiles attacks and drones attacks that are clearly targeting energy infrastructure. The temperature has now dropped quite significantly in Ukraine. They're facing power cuts, and what we have to, in the context of sort of the nuclear risk, is that we have to remember that at this point, Ukraine relies on nuclear energy to provide 40% of its electricity. And what we saw yesterday was reports that Ukraine had to precautiously cut off nuclear power plants from the grid, just to make sure that it's not at risk. So we're sort of on the brink there, and in a very risky situation as the escalation continues.
All right, Piotr, really appreciate your reporting. That is Bloomberg's Piotr Skolimowski joining us from Warsaw. And let's keep the conversation going now with Judy Dempsey. She is non-resident senior fellow for Carnegie Europe, joining us now. And it's great to have you with us, Judy. Put us into the shoes of European leadership right now, confronting the possibility of less American support for Ukraine, the possibility of increased tariffs here. How does one prepare for that?
It's very difficult. I mean, there's so many unpredictabilities, but clearly President-elect Trump wants to move very quickly. He's actually chosen a former general to be his envoy, General Kellogg, to be the special envoy in Ukraine, who will try to conduct negotiations. But the Europeans, they say they want to stay at the table. Well, I'm not so sure they're going to get one. And secondly, if the Trump administration does actually reduce its military support for Ukraine, will the Europeans be ready? There's a shortage of material already. Some countries, such as the Nordic countries, are supplying as much as they can, and some other countries are running short, and some other countries of the EU are a little bit reluctant. So they're not really prepared, but they have been warned of the day after, when Donald Trump enters the White House. And maybe Ukraine is depending on the Europeans for more military support. It's going to be very difficult to muster this very quickly.
And let's talk about the possibility of tariffs here, because, you know, we make jokes about French wine and German cars, for example, but you think about the balance of the European economy right now, and particularly the car industry, for example, which has been under some pressure here. I mean, how much would tariffs hurt? How should we be thinking about that?
The tariffs are an enormous worry for the outgoing German government particularly, and the incoming one, whoever that will be. The real issue is that Donald Trump has a kind of difficult relationship with Germany. He sort of resents its huge export surplus, and the tariffs, 10% tariffs, is very, very high. At the moment, trade between the Eurozone and the United States is reckoned to be about $450 billion a year. And this has actually increased over the COVID times, when trade between Europe and China sort of declined. So the Europeans are increasingly relying on the US market. So you slap tariffs on and they still want to export, it's going to be very, very difficult for them. The other key point is that how the German automobile industry will react. We've seen announced closures in Volkswagen. We've seen the steel industry going to lay off 6,000 or 7,000 workers. What will happen? To avoid tariffs, German manufacturers will probably go over to the United States, which is exactly what Donald Trump would like. But if that happens, it could have a negative spin-off effect for the economies of Europe, because it would mean more job losses and probably less competition.
Judy, I'm curious. I'm not unsympathetic to the challenges that Europe faces in the face of a new Donald Trump administration. But there are a lot of questions, at least from the U.S. lens, as to why Europe wasn't better prepared for this. They've had time. They knew this was a big possibility. And now here we are talking about what, at least on the contour, seems like a surprise to them.
You're talking in the sense of the Ukraine issue?
Ukraine issue, tariffs,
everything. Everything.
Yeah.
Yes, you're quite right. Yes, to use a terrible phrase, the writing has been on the wall, but the Europeans, they do talk an awful lot, and they talk about competitiveness and diversification from China, but they're really not prepared for the tariffs, firstly. Secondly, I think we really have to remember that the European economies are not only going to be hit by the tariffs, they are actually going through a period of deindustrialization at a rather fast pace, largely because of the China influence, what China has done to the electric cars, for instance, but also the whole element of digitization, AI and other issues. The Europeans are incredibly slow to embrace these, and that's another contributing factor for being unprepared for this new kind of transatlantic relationship.
And it raises another question, too, about just how common, if you will, the common Eurozone is. I mean, this is a collection of countries that I don't think have really acted in commonality for quite some time. I don't think they ever did, but they at least managed to put up a good facade for some time. But I think we've seen, with regards to the ructions in France, Germany, and, of course, what's going on in the Eastern Europe, that there just isn't a lot of consensus. So how do you get to a solution?
It's very difficult. And what we've seen over the last, say, 10 years is the increasing role of the member states vis-a-vis the role of the executive, the European Commission. And now the member states, whether it's France, whether it's Germany, whether it's the Netherlands, whether it's the Baltic countries, they're all looking after their national interests. And if you look after national interests, you actually downgrade or make the whole idea of the European Union weaker. There's no talk anymore about integration. There's not even any discussion about what's really necessary is completing monetary union, such as a banking union. And so in some ways, the European Union as an economic project and as a political project has really slowed down, and there's no leadership either in Berlin or Paris and other countries to say, let's put our national interests behind us and try to integrate the European Union further so that we can deal with the new challenges coming from Washington, from China, and of course, Russia and India.
All right, Judy, got to leave it there. Really appreciate you taking the time. Great to get your perspective. That is Judy Dempsey of Carnegie Europe. A lot of big questions, of course. We're 10 weeks away from the inauguration.
Yeah, I've lost track. I mean, look, it's coming up January 20th. I think by law it has to happen by then. And of course, this is a transition team that's been pretty quick on the draw with regards to naming its picks, its nominations here. So we already kind of know what the contours of this administration look like much sooner than what we saw back in 2016, 2017.
That's true. We are getting a lot of details. Hopefully.
Are you going to be in this administration? Because there are a lot of TV stars going to be a part of this administration.
That's true, but they seem to be coming from one network, so I didn't get the call. But in any case, it is Black Friday. Big focus on shopping and the consumer and retail right now. We'll continue that conversation with Jill Standish of Accenture on the outlook this Black Friday. That conversation coming up next. This is Bloomberg. All right, welcome back to Bloomberg Surveillance. I'm Katie Greifeld alongside Romaine Bostic this morning. Let's get you a quick check on your futures right now. Can't imagine there's a lot of volume, but we do have some gains. The S&P 500 up about 0.3%. Same story if you take a look at the NASDAQ 100. Your big tech names up about 0.3%. And we were talking about this a little bit earlier. The small caps resplendent. The Russell 2000 currently higher about 1% or so in this pre-market. 2 hours away from the cash open. Let's get specific and let's get you some morning movers with Manus Kearney.
Katie, good morning to you. There's $37 billion worth of Bitcoin locked inside MicroStrategy. And get ready for more. They're going to make another salvo of purchases, is what we understand. They raised some convertible notes. Originally, we thought it was going to be $2.6 billion worth of proceeds. Looks like that is nearer to 3. And they will, we understand, come in and buy more. But there is a warning from Peter Schiff. He says MicroStrategy is the great short. He flags the risks about repaying some of these convertible bond holders. So it depends which side of that trade you actually want to take on board. We're up 5.125% this morning. Roll it over, have a look at Peabody Energy. Now, coal assets around the world. This is the performance over this week. It's a little bit skittish. Peabody Energy getting ready to buy Anglo American's steel-making coal business. They're going to pay $3.78 billion. At the start of the week, we ran a story that they're raising over $2 billion in debt. So there's this level of discomfort. Don't forget, 2016, this company filed for bankruptcy. Here we are again, taking on more debt to buy new assets. So a little bit of pressure there. I'll leave you with a snapshot of Applied Materials. Everybody in the world is trying to understand the outgoing president's administration policy on China and restrictions on technology. Not as onerous as originally anticipated. The crackdown on semiconductors to China, just less tight than the market had anticipated. This is all about the supply chain into Huawei. Of course, that's the state of play right now. But as the three of us know, come the beginning of 2025, policy on China, on tech, on tariffs, on chips can all be shredded and restarted. Katie.
All right, a lot to look forward there to, Manus Kearney. Thank you very much. And under surveillance this morning, the Bloomberg Dollar Index snapping 8 weeks of gains, Romain Bostic. Traders apparently raising their bets that President-elect Donald Trump will take a more practical approach to tariffs. I'm not sure where that notion came from, but in any case, we did hear Mexican President Claudia Sheinbaum downplaying a potential trade war after a phone call with Trump earlier this week. That did give a little bit of relief to the Mexican peso, but it's been a dramatic move.
Yeah, and this gets us back to that sort of crazy volatility that we saw during the first Trump administration. And always a reminder is don't believe anything unless it comes out of the big man's mouth, because everyone likes to speculate on what's in his head. I don't know what's in his head. Do you know what's in his head?
I don't, I'm not privy to that. But even the things that he does say, you have to also wait and see there until it actually becomes policy, because
until it does have a lot to say. All right, well, we'll see if he takes a more practical approach. Was that the word that you used?
That was good, yes, practical.
Is that the word that we normally use to describe the former president, the president-elect?
Yes, exactly. Okay. Let's move on from currencies to cryptocurrencies.
Can we move on? Okay, go ahead. I don't want to
I had a great Segui lined up. And let's talk about the Bitcoin ETFs. They're heading for a record monthly inflow. This is also related to Trump, as you might expect. Trump optimism specifically. And we've seen the ETFs from issuers, including BlackRock, including Fidelity, attracting $6.2 billion so far this month. Bitcoin, it got pretty close to $100,000. It seemed like it couldn't quite reach it. We were talking about how this is a supply and demand driven market. Because there's no fundamentals, it's also pretty technical too.
Yeah, and the supply demand is a big part of that, and that seems to be where a lot of the speculation is that with not only just a crypto-friendly administration, but then some of these ideas about a crypto and strategic reserve and all these other things like that, obviously that exasperates the supply-demand issue, and maybe that's a big part of the reason for the run-up. MicroStrategy. That's one of the best performing stocks in the Russell 1000, second best performer, and is your best performer in the pre-market today.
That's another big bull case for Bitcoin, is that Michael Saylor is going to try to buy every single Bitcoin. So we'll see if he gets there. Certainly.
Remember when everyone thought he was crazy?
I think that's still
the case.
some
people think he's crazy now.
Crazy like a fox,
but he's made. But I mean, he's put the money where his mouth is, and he's shown that he wasn't crazy necessarily in the bet.
Also, MicroStrategy, I mean, it's been around for decades. It's really interesting to watch the reinvention of both the company and Michael Saylor.
Well, I'm so old, I used to cover this company when it was a software company before you got in trouble with authorities the first time around.
When you would write your articles on a typewriter and all that.
Yes. I miss those days.
Yeah, well, technology is cyclical. In any case, it's Black Friday kicking off in the U.S. Retailers in the U.S. are hoping to see the most shoppers on record over the Thanksgiving weekend. Let's get into it now, because joining us outside of Macy's in Herald Square is Bloomberg's Vonnie Quinn. And Vonnie, the sun is up. It still seems pretty cold out there. What do the lines look like?
Yes, it is a fresh 31 degrees with the wind chill, Katie, and that is a factor actually, because obviously people tend to maybe not come out so much when it is so freezing. We're even getting a little trickle of rain. But I would say that we have had a steady trickle of customers into this iconic Macy's on 35th Street, Herald Square. And that tallies, right? Because we are expecting from data from the National Association of Retailers saying that there will be a record number of people going in store today. So 131.7 million US consumers expected to shop, and 2/3 of those, that's 66% of those, will walk into a store of some kind across the States today. And it's pretty hefty when you think about it, because we are looking for an increase of between 2.5% and 3.5% in terms of spending. Not quite the 3.9% increase we saw last year, but nevertheless, with pandemic savings already drawn down and household debt at a record in the third quarter, that is pretty impressive. Until you think about next year and the possibility of tariffs, as you've been talking about, perhaps it might be wise to get your shopping done this year if those tariffs do indeed get actually put on those goods.
I am curious, Bonnie, I don't know if you've had a chance to actually go inside the Macy's and do a little shopping for yourself, but what are the discounts like this year? I know there was a lot of talk last holiday season that retailers didn't have to discount as much because their inventory levels were under control. It looks like this year, I don't know, are things different?
I did walk around this particular Macy's. You do see a lot of 40% off, 50% off. You'd have to do a lot of research to actually figure out if that is the cheapest that we can have for these particular, items, typically apparel or something, along those lines.
Yeah.
That said,
where'd you get
there's
that
price
coat from?
matching,
Is that a
right?
new coat that you have?
We're in a whole different era. This was last year's Black Friday sale. I'm being very good this year. I'm spending on everybody else this year, of course, Romaine. But, in terms of discounts, though, Adobe Analytics has done the calculations, and they found that out of 18 categories, electronics will be discounted the most. They're expecting that to be discounted 30%. And then it goes down to toys, down 27%, all the way down to appliances. And I know you're looking for that Ninja blender, a new Ninja blender perhaps for the kitchen, 18%. So there are categories, and obviously, the word on the street is don't buy unless you see those items discounted at least that much.
All right, you got to be disciplined out there. Bloomberg's Bonnie Quinn reporting outside of Macy's, braving the cold. Romaine, you've got something to say. 18%.
I don't get out of bed for less than for anything less than 20%.
Well, I know you have some big Black Friday plans.
Yeah.
What's top of your list?
Well, apparently my mother wants to actually walk around and go shopping in 30-degree weather. So apparently that's what we're going to do after the show.
All right, well, buy some new coats. Let's keep the conversation going with Jill Standish. She is head of retail over at Accenture Global, joining us now. And Jill, I want to go to this line in your notes. You write that retailers have good reason to be cautiously optimistic, which is interesting because we talk about all of these headwinds potentially coming at retailers next year. What is the case for optimism right now?
Well, in our survey, which we did right before holiday, basically people said they're going to spend upwards of 4% more this year compared to last year. So that's the optimism. The cautious is about the fact that everyone's looking for a deal. I mean, you heard in the other correspondent's point, everyone's out there for Black Friday because they know that there's sales on today.
Sales on today, but we were joking earlier that Black Friday, it's really a state of mind. It never ends. I was actually out and about on Tuesday getting great deals as well. I mean, this bleeding out of the bounds of Black Friday, what does that ultimately mean for retailers? Because it seems like it's just persistent discounting.
Well, listen, agility is being put to the test this year because shoppers have only one less week compared to last year because it's where Thanksgiving fell. So retailers are really smart. They said, listen, I'm going to start doing my discounting early so I can get people to start shopping early. And listen, AI has been on the pitch for a long time in retail, where retailers were planning out when to put things on sale. So that hopefully will help them make sure that they don't lose margin over this period. It's all being worked out through advanced technology, which is great to see.
I am curious just about how much some of these retailers can sort of prod the consumer into buying certain things. I mean, some of us, Jill, we have a hard time figuring out what to buy what to buy for our loved ones. What gifts do they really want? And I know some retailers have taken a more creative approach, kind of to really put out these gift guides and create other experiences when they're in their store to sort of plant those seeds in your head, probably for the more expensive stuff. But still, what are they doing?
Yeah, listen, this year is the year of curation and recommendation. Retailers know that people are getting inspiration from all different sources, whether that's Instagram or Meta or Facebook, you name it. There's a bunch of places where people are getting suggestion. Some of the curation is happening not just in the store with really smart people working the store saying, here's what you should buy. It's also happening with technology. So think about if you're online and all of a sudden this little pop-up comes that says, hey, do you need any help? Who are you buying for? What are you looking for? What's your budget? Those types of recommendations is going to be what the future looks like in retail. So instead of you trying to search, people are trying to help you, trying to make it easy on you.
I am curious, too, with regards to physical stores and the idea of a lot of these physical stores trying to find ways to get people back in. We were just checking in with Macy's in Herald Square here in New York, which, of course, just really decks out a store. I mean, you go to that store just to see the displays and hopefully you buy something along the way. I know Bloomingdale's right across from Bloomberg headquarters here also has these pretty expansive displays. Are we seeing these stores embrace that more? Because there have been some stores that said they're actually pulling back. Saks said they're not doing their normal light show this year.
Yeah, you know, stores are back this year, which is fantastic. You heard that stat that said there's a bunch of folks that are going to be shopping in stores this year. And so there is that retail shopping fun where you get together with your friends and you go to the stores. It's not so much about the decorations as much as it is about that feeling on Black Friday or Cyber Monday, going in and going shopping. I think the key for retailers this year is going to be all about, again, curation, recommendation, and then let's not forget the store staff. Frontline workers have been really part of the equation. I always say you can have the best discount, the best promotions, the best curation, the best assortment, but if that person behind the till is not in a good mood, it could really, really change your opinion of that retailer.
Amen.
So frontline workers is also something that retailers are taking care of this year.
Yeah, it's a great point that service matters. I want to go to another line in your note because I thought this was interesting, that retailers are focusing on inspirational content, which actually can improve sales according to your data. What is inspirational content, though?
Well, listen, I talked a little bit about AI, and AI has been used a lot of times with figuring out, again, your assortment, figuring out how best to make sure that the supply is right, also how to get it to the store. And then, of course, you're using all sorts of AI for doing curation around your ads and your promotions. But now, because of advanced technology, now the way that you advertise is also being inspirational. So you can have more tailored advertising to consumers now, which is fantastic, a lot because of Gen AI. So that's what I mean by inspirational. And also gift ideas, suggestions, recommendations, that's on the pitch this year. It's the year of curation. You know, I always like to say, where do people get their inspiration? Do they get it from, you know, looking at Instagram? Do they get it from going on the website of the retailer? Most retailers are saying, listen, I've got to play a big role of making sure that eyeballs come to my website. How do I get them there? Maybe I do have some ads on Instagram to get you to click through to come to my website.
Absolutely, all about tantalizing folks. Jill Standish over at Accenture Global, the head of retail there. A closer look here at the holiday shopping season, which ostensibly kicks off today here on Black Friday. But quite frankly, it kicked off days, if not weeks ago. Just so not too long ago, Scarlett Fu, a co-anchor of mine, had a chance to catch up with the CEO of Bloomingdale's, Olivier Braun, about the holiday season and the future of the department store model.
The models in Asia and Europe right now are really flagship focused. So I think that's one big difference. And honestly, I think the flagships will have a bright future in the next 10, 20 years. It's not, I think, a problem at all. I think the problem here is managing such a large footprint. And that can be a challenge sometimes. At Bloomingdale's, we have the chance to be in prime locations and prime malls, so very strong locations. We have a limited footprint. So I think we have more opportunities than threats for Bloomingdale's in the future. I really do think that actually the department store model has a bright future, but it has to reinvent itself from the perspective of the customer, but also from our brand partners. We have to be relevant for our brand partners and rethink the model from this point of view.
How about the broader retail landscape overall? Are there too many stores in the U.S. overall?
when you look at the pure market data, when you look at the overall market is actually slightly growing. The penetration of online is going up. So for sure, the average productivity of the square feet overall in the US is actually slightly decreasing. So yes, there will be probably some losers. It's why you have to challenge yourself and reinvent your model to remain relevant for your customers, but also for your partners.
I have to ask you, when you look at other retailers, and it doesn't necessarily have to be a direct competitor, who do you envy most? Like when you walk into their stores or you shop on their website, who do you just say, wow, they really got it right. I want to try to emulate some of this.
No, first, I really think that actually Bloomingdale's is doing that right. When I discovered the model, I'm sorry to say, but I'd say, no, but it's not the only, it won't be my only answer. But actually, honestly, I was very surprised by the level of engagement of the customer. The relationship that we're building with the customer and with our partners is actually good. And I think we can even do better in the future. But I think there's a lot of source of inspirations from our competitors, but also from other models right now, whether it's in terms of service, in terms of brand mix, in terms of events and activations. There are a lot of inspirations that are in retail and beyond retail. I don't want to give you any names, but I have a lot of source of inspiration actually in the US, but also abroad, which is another thing. I think we should not be too domestic focused because we're going to miss probably some good trends that are happening somewhere in the world.
And you think that maybe what we see abroad in terms of their approach to department stores and just retail overall, you think that's going to be palatable to a U.S. audience?
I'm absolutely convinced about that. I think, we have to bring the best of both worlds, and I think this is where we're going to perform and bring something different for the customer. The customer is ready right now for something different, more inspiring. And this, we can get it from some of the countries or some of the other models in the world.
And that was part of my conversation I had with Bloomingdale's CEO, Olivier Braun, just a little while ago. And if you notice all that green behind him, we filmed that right at the start of this big promotion they had with Wicked.
Yeah.
And I actually got to go. They had this big opening night where they had the stars of Wicked, Cynthia Erivo. I got to, I grabbed her little finger and I said, it's going to be okay. And she sung to me. It was very beautiful. Yeah.
That was the start of their promotion of Wicked, Bloomingdale's. But the Wicked promotion has been going on forever.
Yes.
Have you seen the movie?
I have not, but I kind of feel like with all the advertising, I sort of feel like I've seen it, whether I wanted to or not. Are you going to go see this movie?
I'm going to go see it.
Yeah.
I see a lot of clips on TikTok, so I feel like I've already watched the entire movie.
Well, there's two parts to it.
Yeah.
So I'm just going to wait till the second one comes out and then watch them together.
Just going to binge it all at once. That's not a bad plan.
I don't want to be lost.
I feel like I have to watch it, though.
Yeah.
I mean, I'm also a huge
And I'm confused because I've never seen the play. So is this, it's the Wizard of Oz, but not, or what?
It's in the same universe.
It's like the origin story? It's like the prequel?
Exactly.
So this is like when we found out like Anakin was Darth Vader or something like that?
I'm not a huge Star Wars buff, so I can't really comment on.
Is that Star Wars or Star Trek? I don't know. Once I made a Star Wars joke and I got it wrong, and every geek in the world sent me an instant message saying, no, that's the Millennium Falcon. I don't care.
I don't even play in that sandbox.
By the way, Damien Sassower writing in. Remember him, friend of the show?
Damo.
He says, Demolition Man, underrated.
Really?
Says one of the best performances by Wesley Snipes. And if you can't trust Damien Sassower for your movie reviews, who can you?
I got a tweet to that effect, and I would trust anyone on the internet. So put that on your viewing list. Demolition Man. But don't go anywhere, because coming up, drivers getting some relief from higher gas prices. We'll speak with Linnea Geiss. She is retail analyst, chief operating officer over at PDI Technologies. That conversation up next. This is Bloomberg Surveillance. All right, welcome back to Bloomberg Surveillance. Let's get a quick check on these markets right now. Still green on the screen. Again, I don't know how much volume there could possibly be, but the S&P 500 higher by about 0.2%. We were a little bit higher a little bit while ago, but still counts. Then you take a look at the Euro USD, pretty much unchanged on the day, hanging out at around 105. These are all assets that I rarely look at on open interest.
I don't understand why you're poo-pooing the S&P futures. 60.2725. That's going to be a record high if that holds into the cash session.
That's true. And if these gains hold, it could flip this into the best month of the year. But you don't get out of bed for, less than 18% of a discount? This doesn't quite thrill me.
But I like this. We've been talking a lot about this on the close, these incremental moves in the market. And sometimes that's healthy. healthy
Yeah.
when you have that rally, rather than just get a rip-roaring, 2-3% a day. Sometimes it's these fractional gains that matter most, Katie.
See, you're a good anchor because you sell the
I am
small
the good
moves,
anchor.
but
It's like good witch, bad witch. Isn't that the plot of Wicked? Good anchor, bad anchor?
Yeah, so you're,
How would
you're
that sequel
Glinda
do?
and I'm Elphaba.
I don't know what that means, but okay.
In any
Should I grab
case-
your finger?
Please don't. We'd have to reach pretty far. Let's talk about gas because AAA expecting record-setting travel numbers this week. The agency estimating nearly 80 million people are traveling 50 miles or more for Thanksgiving. And joining us now is Linnea Geiss. She is convenience retail analyst and COO of PDI Technologies, joining us now. Great to have you with us. And taking a look at some of the notes that you sent over, you write that this is the cheapest Thanksgiving holiday for gas prices since 2020, which I think would surprise a lot of people. So walk us through what actually got us to these levels.
Well, it really is. Consumers are experiencing, like you said, the cheapest gas price. And so that is good news for everyone who's hitting the road. 72% of our gas buddies have said that they're traveling. So that tracks with the national statistics. And honestly, some of it's really just driven by overall economic slowdown and demand factors. So the consumers out there are still a little bit skittish, and the convenience retail operators are looking to entice the consumers to come into their stores. And that more competitive environment is driving down prices for everybody.
Is there a sort of still a benefit to trying to shop for cheaper gas prices? I remember like for years, my uncle Ed, who's probably watching, good morning, Ed, he lives like right on the border of Illinois, Indiana, and he always goes across the border to Indiana, to get, his gas and, other illicit things, and then drives back across the border. Is that still a thing?
Oh, absolutely. Competitive gas price shopping is a huge trend. Actually, it's a big gamification. You can find deal shoppers on the internet really telling you where to find the cheapest gas. And you nailed it, actually. Your uncle's quite smart. The gas taxes differ from state to state. So sometimes when you're looking to be on the road, you want to make sure that you do your research in advance and try and understand whether or not you will find a better discount by crossing the border.
See, I push it to the very limit till I have like 10 miles left, and then I just have to accept any price I can get. So I need to take a page out of...
You're a price taker.
Exactly. I need to learn from your uncle there. But let's talk a little bit about what could happen next year. Of course, there's a lot of consternation over potential tariffs on Mexico, on Canada, too. I mean, what could the impact on the gas picture be coming into 2025?
Well, I think there's still so much uncertainty, and as you know, many things are interconnected. But we do import a significant amount of crude from Canada, and so that impact certainly would be felt by any part of the supply chain that experiences that impact. And so we've modeled internally here that roughly a 25% tariff could increase prices as much as 30 to 70 cents per gallon, particularly up in the Great Lakes and the Midwest region, and then feeling that even still a little bit down into the Rust Belt.
All right, Linnea, great perspective. Appreciate your time. That is Linnea Geiss of PDI Technologies. Thank you so much. And somehow it's been 2 hours, Romaine. Can you believe it?
It's been 2 hours, and somehow we've made it this far without actually falling asleep or anything. I don't know how Farrow, Abramowitz, and Horton actually do this every morning. Did they actually wake up every morning at like 2, 3 in the morning and come in and do this?
They must be constantly jet-lagged. This is like European.
I don't know. I don't think Farrow ever leaves the office.
No.
Abramowitz, I see her. She actually lives near me.
Yeah.
I kind of avoid eye contact with her
true.
when I see her on the street, as you normally do when you see your coworkers out in the wild. But
I'm not sure where
she's a
AMH
nice person.
lives, but it must be somewhere chic because she has the outfit to go with it.
She always has those fancy shoes on.
I know.
I don't know. Are those good for walking around New York City?
I think you have to be careful, but I don't know. Whitney Tilson wants to clean it up. In any case, don't go anywhere. We have a great final hour coming up. Michael Green, he is Chief Strategist at Simplify. He'll join us along with Eric Fisch of HSBC, and we're rounding it out with Kristina Hooper of Invesco.
Hey, happy birthday, Russell Wilson.
All right, Russell
Pride
Wilson.
of Cincinnati.
Yeah, thanks for tuning in. This is Bloomberg.
The consumer is being very purposeful in their spending.
Consumers just haven't been shopping as much.
This is a happy period for the consumer, but it is, again, a sensitive period.
If you look at the retailers that are sort of winning in this environment, it's those who truly are kind of giving back real value to the consumer.
Where there's newness and innovation, consumers are going.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City, for our audiences worldwide, good morning. This is Bloomberg Surveillance. Romaine Bostic alongside Katie Greifeld, John, Anne-Marie, Lisa, having the day off here on this Black Friday. Maybe they're out shopping. Maybe they are those happy consumers. But a happy day, Katie Greifeld, right now in equity markets. Fractional gains on the day in futures markets, but we're closing out the month higher on the S&P by 5%.
Yeah, big time. Big month for the equity market, potentially the best month of the year. The Russell 2000 up 0.9%. I was taking a look at the month-to-date performance for the small caps, up 10.5% through Wednesday's close. That is the best month in about a year, and it has just been something to watch.
And you look at the gains that we saw in the month and even on this morning here, light volume to be sure. The cash session for equities opens as normal at 9:30. Stocks will shut down, though, at 1 p.m. The bond market closing at 2. And when you look at some of the individual movers, Katie, we were talking a little bit earlier about MicroStrategy. We'll get back to Bitcoin in a second. But I also thought it was interesting, too. You're seeing some big movements in a lot of the semiconductor equipment stocks. Some interesting news out of China that they may not be as retaliatory in this tariff tit for tat, particularly when it comes to the semi space.
And that would certainly be good news. Of course, we're trying to track the contours of what a new tariff regime coming out of the Trump administration would look like, what retaliation would look like, and what the ultimate effect both on the stock market and on actual people would be. You think about the semiconductor space in particular, really the lifeblood of this market. It's nice to have the broadening out, but you need to have tech participation for that bull market.
You're also seeing a modest bid come into Bitcoin on this day, up about 2%. This is on the back of what is shaping up to be a 39% run up this month alone, more than doubling on a year-to-date basis. I don't know if you were following this story.
Yeah.
Because there's a lot of money sloshing around in the crypto sector. And now this cryptocurrency investor, Justin Sun, did you hear about this? He bought this, a banana artwork. Are you familiar with this?
He bought the banana. I heard about the banana selling for $6.2 million.
And it's not just a banana. It's a banana on a wall, taped to a wall. That's the art, right?
It makes you think.
Yeah.
Yeah.
It does make you think. It's called absurdist art. But the funny thing about it, this thing sold for more than $6 million at Sotheby's. And it turns out, I didn't realize this. I guess it makes sense because you just can't have an old banana on the wall. You have to get new bananas for this.
Yeah.
So apparently, they bought the banana just from some vendor on the street for like 25, 35 cents who was sitting outside. This guy makes $12 an hour. And then the media tracked him down. They say, hey, you know that banana you just sold for pennies? Just sold for millions of dollars.
That feels mean.
Yeah.
I feel like they could have left that man alone. But you hear stories like this, and
I feel for him.
You could make the case that financial conditions are looking a little loose here, Romaine.
I don't know what I'm looking at here. I mean, I know it's a banana taped to a wall.
Yeah, let me
I know
tell
that
you.
much. But we went through this before, and I mean, look, I guess art is it's whatever you want it to be, and this is a form of art, and there are people with a lot of money to burn that want to partake in this absurdity.
You could make the case then that the entire crypto industry is a form of art then, because it's just whatever someone is willing to pay. And at least in the case of this banana, at least for a single Bitcoin, people are willing to pay a lot, Romaine.
I would have loved to have been at this. The only other auction I would have loved to have been at was that one Banksy one where they ripped up, where the painting basically went through the shredder. That was fun.
Everyone gasped.
Yeah, I'd pay $6 million for that. But
Shock and awe.
But speaking of Bitcoin here, we talk about this idea of it being more art than science. It has actually, of course, brought out the scientists and the technical strategists as that run-up continues apace. Let's keep the conversation going right now with Michael Green, Chief Strategist at Simplify Asset Management. We're going to hear from him in just a second. Eric Fisch of HSBC going to be talking about what's going on in the consumer space, and friend of the show, Kristina Hooper over at Invesco, also going to be talking with us as well. But we begin this hour with Michael Green. He is the Chief Strategist at Simplify Asset Management. Michael, thanks for joining us here on this Black Friday. We'll let you get to shopping in just a second. But I do want to start, before we get to the broader market, I do want to start with cryptocurrency for a bit here, because this really has been one of the big barometers of the risk-on sentiment that we've seen over the past few weeks. Kind of started even before the election, but of course picked up a lot of steam once people got a look at what is going to be a new Trump administration in January. You see this momentum continuing?
Well, I think the real question is, does the buying continue, right? So we've seen extraordinary inflows into products like BlackRock's Bitcoin ETF. We've seen an incredible innovation, in quotes, right? The classic financial innovation with the single stock ETFs that have powered entities like MicroStrategy over the past month or so. Those seem to be running out of gas, and the financing costs associated with them, I think, kind of give lie to this idea that financial conditions are affected in any way, shape, or form by what the Federal Reserve is doing right now. But this is clearly one of these things that is indicative of both people's expectations that the craziness is only kind of going to accelerate as it relates to government spending or inflation or the risks associated with the Trump administration.
And as people sort of take a look at that, Michael, and they try to sort of make bets in the crypto sphere, we've seen a lot of people looking for proxies to do that. MicroStrategy, of course, was the proxy for quite some time. We started to see ETFs come into this space, and we've started to see more of an embrace, not only by retail investors, but by the institutional set as well. Do you expect that to continue? Do you expect the embrace of crypto to be much more through these proxy vehicles rather than through the actual crypto asset itself?
Well, I think this actually tells you something about the space, right? Which is that there still is very little utility associated with the actual tokens themselves. Ultimately, this idea of digitally native securities is incredibly important. It really is an incredible innovation to think about changing away from our still paper-based financial system to one that's really built around digitization and securities that are capable of having complex instruction sets embedded inside them. But right now, we're basically just trying to build enthusiasm for the space. And that is clearly being driven by promotional activity. We see that across the space, everywhere from BlackRock on down to the extremes of the Michael Saylors.
Well, let's talk a little bit about these MicroStrategy single stock leverage ETFs. I want to jump right into the weeds here because as reported by Bloomberg's Vildana Heinrich, you're seeing this really interesting dynamic where they can't get their exposure through swaps anymore. They have to basically tap the options market and buy these call options. And there's been a lot of concern about that, but I want to ask why? What is the end effect on the end client, or is this more a problem for the issuers?
So there's two separate components associated with it. One is it is clearly an issue for the issuers themselves in that their prospectuses do not disclose the use of options. And so by attempting to maintain their investment mandate, moving away from swaps into options, they are incurring costs in pursuing their investment strategies that are not fully disclosed to their investors. That potentially creates liability at some point in the future should these begin to underperform. By my calculations, the financing costs are somewhere in the range of 5 to 10% per month at this point. So while we sit here debating the idea, should the Fed cut by 25 basis points, we're seeing areas of the market that are being propelled by speculation with interest rates closer to 100%. So it really is not anything to do with the Fed at this point, I would argue. The second issue that you have is that financing cost, because it ultimately means that these vehicles are facing a bleed associated with a failure of those options to go further into the money or deliver against their volatility. That means that the carrying costs of these products are also in that kind of 5% plus 10% area, meaning that the Bitcoin market and the MicroStrategy market has to continue to rise at nearly 100% a year in order for these products to break even. That's a very, that is an incredible headwind. And a lot of the behavior that we're seeing in these single stock levered ETFs, I think ultimately we're going to find out will be treated as various forms of manipulation, and in all likelihood, we'll see this stuff pulled off the market at some point in the future.
Well, we'll see. That would certainly be dramatic. But to put it simply, of course, these are not meant to be buy and hold investments. The issuers themselves would tell you that. But I want to talk, too, about the relationship between these leveraged single stock MicroStrategy ETFs and what it means for the actual MicroStrategy underlying stock, because you see MicroStrategy trading at a record premium, I believe, to Bitcoin itself. And there's some theories out there that it's actually these leveraged single stock vehicles that are driving that.
Yeah, I don't think there's any question about that. If you look at the increase in premium that occurred, it happened almost simultaneously with the launch of the largest of these levered ETFs, MSTU being the ticker there. That actually very clearly powered this separation. There's very little to actually debate around that that's allowed it to push itself beyond Bitcoin. Now, what that's created is something similar to what happened with Grayscale Bitcoin Trust a year ago, or 2 years ago, in which a premium that it developed for Grayscale Bitcoin Trust created demand for Bitcoin. This is working almost in reverse. The premium for MicroStrategy is leading to MicroStrategy being able to issue shares and in turn buy Bitcoin. It's a far less direct route, but it's the same underlying effect that continues to power both the stock and the coin, the token, higher at this point.
And just real quickly, Michael, I am curious that when we start to, we're talking about this in the context specifically within the crypto sphere, does some of that optimism, does that bleed out into the broader market? I mean, can we take cues from what's going on in the crypto sphere for the rest of the market?
I think it's hard not to assume that there are going to be implications associated with this, right? So you have individuals who are investors in Bitcoin who are feeling flush in the environment that will lead to them increasing their purchasing activity, et cetera. So there are real world feedbacks to this. There's also very real world feedbacks in the kind of the classic George Soros reflexivity component. This type of price activity facilitates MicroStrategy going out and raising real cash in the form of convertible debt, which is, or issuance of shares, which in turn is used to purchase that Bitcoin.
Yeah.
They could theoretically hold on to that cash and use it for alternative corporate purchases, as we saw with stocks like GameStop or with AMC Entertainment. So far, Saylor seems to be much more aggressive in this process.
All right, Michael, great stuff. Going to leave it there. Have a wonderful rest of your week and weekend. Michael Green over at Simplify Asset Management here on this Black Friday. When we come back, we are going to focus a little bit more on what's been going on with lines of shoppers outside the stores and the retail trends. But I think, Katie, we have to take a moment here to pour one out for a trailblazer when it comes to sartorial elegance. We just learned.
Are we talking about a person?
Well, even better.
Yeah.
We're talking about a Shiba Inu. Bodhi, the menswear dog. You may not recognize his name, but you've definitely seen his face. This was a dog that came to fame back in 2013 when its owner just decided to dress him up in a bunch of Ralph Lauren samples. And of course, this just took off. This is a real dog in real clothes. And he looks better than both of us here. He could be hosting this show. Unfortunately, he passed away, but he was at the ripe old age of 15, which for a dog, that's a good run.
Yeah, that is pretty impressive. I do wonder what happens to the account now. Does it just live on, but
I don't know. Maybe
without any new content?
Maybe there'll be a Bodhi 2.0. I don't know, but I just think about him and I think this is this time of year, right? He would be out there looking for those 40% off sales, those cashmere sweaters at Banana Republic or
Bodhi
whatever.
the dog couldn't hang on for one last Black Friday. It's a really sad story, but I think I finally found a use case for AI. And it's creating images of this now deceased dog.
All right, love them. Pour one out for Bodhi here on this Black Friday. We are going to talk about some of those retail trends when we come back here on Bloomberg Surveillance. Eric Fisch over at HSBC. He's stopping by the big program. Stick with us. This is Bloomberg. And Bloomberg Surveillance rolls on even as John, Anne Marie, and Lisa decided not to come to work. So I have your morning calls for the day. First up, D.A. Davidson raising its price target on Planet Fitness. $87 a share, a neutral rating to analysts, pointing to membership growth and a monthly fee increase. Those shares fractionally higher here in the pre-market session. Next up, Citi raising its price target on Ulta Beauty to $390 a share. This on the stock's balanced risk-reward. The shares, though, unchanged here in light trading on Black Friday. And finally, Morgan Stanley lowering its price target on Kohl's to $13. The analyst saying current strategies may have actually impaired the business further.
You hate to see that. If
Yeah.
you're current management, that one's got to hurt.
Yeah, and Kohl's, those shares been under pressure, higher here in the early trade by only about 1%. But of course, the damage in that stock has been done. Maybe a turnaround story there. A lot, of course, will depend on how the holiday shopping season plays out. A holiday shopping season, of course, that kicks off about 5 days later than what it normally would. Outside of Macy's flagship store, Herald Square, New York City, is none other than Bonnie Quinn, who's standing by, keeping an eye on how many people are filing in and out of there. And Bonnie, I don't know what that crash was. Was that Santa Claus coming down the chimney? What is that?
That was a New York City trash can, as only
That's
New York
fitting.
City can provide, Romaine. But as you can see, we are seeing a steady stream of customers into Macy's. We're open about 2 hours, 15 minutes now, and what started as just a trickle has really turned into something a little bit more. And if you walk around inside, it's actually pleasantly full. So it's not a throng of people, but that does tally with the numbers that have been projected. So the National Retail Association saying there will be a record number of shoppers this year, 131.7 million, and 2/3 of those will walk into a store somewhere across the United States. That's a pretty phenomenal number when you think about it, and when you realize that the death of Black Friday has been called for many, many years now. Well, it's clearly still a tradition. It's clearly still something sociable that you do with friends and family. We've talked to many tourists from the West Coast, from Turkey, who just arrived in the city and wanted to go straight to Macy's for their doorbusters and all of their, you know, Black Friday to Cyber Monday sales. And
well, talk to us too about that stat that you laid out, 31 million expected to walk into a store. Give us some context. How does that compare to prior years, for example?
Well, so it's going to be a record, Katie, if that does actually come to pass. 2/3 of 131.7 million. So that's really a phenomenal number. That's almost, 35 million. So when you think about what they're spending, that's also important. We are looking for growth of between 2.5% and 3.5%, which is down from the 3.9% growth rate that we saw last year, but is healthy growth nonetheless when you consider that household spending is still holding up, but also household debt is going up as well. We saw that in the third quarter, it reached a record, and those pandemic savings are gone. One interesting poll that was done was by YouGov, of all people. They found that of those they polled, just 9% plan to spend more than they did last year. Most of the shoppers that are going to spend a little bit less than last year. So there's all kinds of numbers floating around there. You obviously won't know until next week, but we did get a little taster of it when we saw those company earnings, right? So the companies that got it right, the Walmarts, pulled people in from all sorts of demographics, all sorts of income brackets, and those that didn't, Target, for example, they got mixed up with their inventory problems and they just didn't attract those customers. So we are seeing a discerning customer.
Vonnie Quinn outside the Macy's in Herald Square. And of course, it wouldn't be a New York report without a trash can being banged around in the background. Welcome to our world from Studio 5 at Bloomberg headquarters in New York. We keep it rolling with Eric Fisch, HSBC, U.S. Commercial Banking Head of Retail and Apparel. And you saw Vonnie out there. The lines aren't as long. You would expect that given that, a lot of folks, of course, now buy online. Put it all together in aggregate. Are we going to be looking at a better holiday shopping season this time around than in 2023?
Yeah, what I'm hearing from my clients is expected growth. Mm-hmm. So we came into the season after an election where there was anxiety. And coming out of that, stores immediately launched sales. Mm-hmm. So as you mentioned, shorter holiday season, 5 days shorter than last year. And so what that created was a bit of a sprint. And the shoppers have responded. So sales through November so far up over last year.
I am curious as to what people are going to be buying. Bloomberg actually now has out its own sort of gift buying guide here, which includes something pedestrian like hand cream for a few bucks to a bespoke globe that will cost you more than $1,500. What are people going to spend? Are they going to spend for kind of more those lower end or middle of the road items, or are they going to splurge on something that's maybe a little bit more luxury, a little bit more discretionary, or like a bespoke globe, completely unnecessary?
Yeah, I think what in general we're seeing this year is people looking for value. Mm-hmm. So regardless of what price point you normally shop in, if you were a luxury shopper, we're seeing a lot of people shifting to designer, contemporary, mass affluent. Same thing at lower price points. A lot of interest in off-price if you were normally a department store shopper. Mm-hmm. So unlocking that perceived value is critical to the shopper.
I'm just curious on off-price, though. Yeah. Does that mean they don't go to the department store and then they go to, I don't know, say a TJ Maxx or something? Because can the department stores not compete in that space?
Now, a lot of those department stores have off-price channels. Gotcha. And so those have been growing as well.
Okay.
It's finding those brand names that you've come to trust, but at that better value and lower price point,
I want to talk a little bit more specifically about luxury because the narrative, of course, has been that luxury is resilient. It's sort of the last to crack here, but we have seen some tremors. So just give us a more specific channel check on how luxury actually is.
Yeah, I think I'm not going to lose a lot of sleep for the luxury sector. They've had some phenomenal years, and I think we've reached a point where it's hard to comp up over the phenomenal growth. At the same time, they've raised prices considerably, especially since COVID, some almost doubling the price of their product. And so what that's created is an environment where the aspirational shopper, the person who isn't a typical luxury shopper, is buying up, has been priced out a bit.
That's interesting. So basically luxury raised it too much for that aspirational shopper. How does pricing work at the luxury sector? Because, I mean, you think about sort of these bigger brands, we talk about discounting all the time. How sticky are prices when it comes to luxury?
Yeah, it's a great question. I think we'll really see that play out now that the comps have not performed. I think in general, luxury brands, it's self-fulfilling, where you raise prices, which weeds out some of the aspirational shopper, which makes it more scarce, which makes it more desirable, which makes people want to buy it more. So it's almost a virtuous cycle for them, but they have to live through some of these negative comps to get back to that.
I want to talk about the technology involved right now in the shopper experience. And let's start with the way the stores deploy it. We've seen more use of cameras, not just to track whether I'm going to walk out the door with something that I didn't pay for, but also to look at what I'm looking at, how I'm looking at it, whether I'm touching it, whether I'm willing to try it on. And in theory, you put all this together and you have a better way to target me as a consumer.
Yeah, I think this is where AI comes in. If you think about a typical small store and may have 6 to 8 cameras, you'd have to have a full-time person there for surveillance, for theft. So AI can trigger when there's something suspicious. At the same time, to your point, you have cameras that can notice where someone's eyes are looking, where they're glancing, what items they're looking at, and then aggregate that information and show real heat maps of where in a store to put the highest volume items, where people are really not going. So I think a lot of opportunity to improve efficiencies.
It's a little dystopian, though. We're constantly being watched. They're watching our eyeballs move around, but opportunity, like you say. Talk to us globally here, because we were talking about luxury. You think about European luxury and how that's performing. But when it comes to global appetite for more US-centric brands, how does that shape up right now?
Yeah, it's a little bit of a contradiction in that we speak a lot about how the Chinese consumer has slowed down a bit in purchasing. Europe as well has been a little bit of a stagnant market. But at the same time, US brands continue to perform very well in those markets. The US continues to be the cultural touchstone for the world.
Wow.
Hollywood and the way we export culture. And so what that's created is opportunities for US brands to continue to expand. And I think sometimes we get caught up in large, mature markets that are still great opportunities for new entrants, right?
All right, USA, baby.
All right, Eric, great stuff. Eric Fisch over at HSBC, excuse me, joining us here in Studio 5. And I just want to point out, too, we've got a great live blog on the Bloomberg terminal. Julia Fanzaris, one of our reporters, is out at a Macy's in Bethesda, Maryland. I just want to give you the color that she's providing into this blog here, basically saying that only about 20 people showed up outside of the store in Bethesda, Maryland this morning. They said the store still kind of remained in partial darkness even after the doors were open. And she said that the busiest thing going on at the store is next door at the Starbucks.
I would 100% believe that. That is some great on-the-ground color that Bloomberg News is providing.
All right, a lot more coming up here on Bloomberg Surveillance. The takeover, the open and the close, together as one, like the Wonder Twins. Kristina Hooper going to be joining us when we come back after the break over at Invesco. You're watching Bloomberg Surveillance. This is Bloomberg Surveillance. Romaine Bostick alongside Katie Greifeld as we wait for the open of the cash session here in U.S. markets. Just about 1 hour away. S&P futures up by about 0.2% here on the day. Similar moves across the other parts of the major indices, with the Russell 2000 doing what it's done for really the last few weeks here, and that is outperform the broader market. A cyclical rotation, if you will. Taking a look at what's moving in the pre-market trade and what is decidedly going to be relatively light trading as well as an early close for this market. Let's get right to Manus Cranny, who's standing by with our morning movers. Manus.
Romaine, a very good morning to you. There's a juggernaut. It's called, well, actually, we're going to get off with Applied Materials. What you got here is just less onerous regulation than what we thought was going to be inflicted on those suppliers into China in the semiconductors business. So the crackdown is less severe, and this is just a representation up 2 1/8 at the moment. Of course, all that can change as soon as Donald Trump and the next president-elect comes to power in terms of what will happen with tech into China. Roll it over and have a look at some of the other stocks that I'm focused on, which is Applied Materials. Now, this is a rejection by the FDA. One of the drugs that they had put in is called Govorestat. It's an application. It's for a genetics disorder, but that's been pushed back by the FDA. RBC come out and they downgrade the stock to sector perform. They say there's significant uncertainties. Look at that, down 75% at the moment. You need more data. It needs a much more convincing package to go back into the FDA. I'll leave you with a snapshot of what's going on in MicroStrategy. Look, it's a vicarious trade on Bitcoin. You've talked a little bit about that, but what we've got here is 5 convertible bond issues so far, raising money to buy more Bitcoin. It depends what you believe, whether there's anything that can go wrong in this. And Peter Schiff, he's the famed economist, he's saying, look, this is a great short. This stock is a great short for him. He flags the risks on the repayments on those convertibles. But let me put it to you this way. The week after Donald Trump was elected, the next president-elect, $217 million flew into this stock. So there was a real velocity in terms of ownership. Lots of narratives. 1 was Bitcoin, 2 is deregulation. So let's see what 2025 brings on the vicarious trade. Good morning.
Good morning to Manus Granny there, and good morning to our viewers worldwide. We talk about a market here that looks like it's setting up for gains to close out the month of November, a month that has been stellar pretty much across the board. 5% gains on the S&P 500. And Katie?
Yes.
11. No, I take that back. I was wrong. 10 of the 11 S&P sectors in the green for the month, led by discretionary stocks.
You were pretty close. What is the lone underperformance?
It was healthcare, which is right now relatively unchanged. So it's still a chance in the shortened trading session.
That's true. They have a couple of hours. It's interesting, though, because you think about all this euphoria and optimism about M&A maybe in 2025. Healthcare is always named, along with financials, but you haven't seen that enthusiasm necessarily come through in the stocks yet.
A stellar month for financials. S&P financials up 10%. The KBW Bank Index doing even better than that on the month. On here, the final trading day of November as we head into December and into 2025. Let's get some insights out of Kristina Hooper, Chief Global Market Strategist over at Invesco. Happy Thanksgiving, Kristina. Great to see you.
Great to see you too, Romaine.
It's been a pretty good month. It's been a pretty good year. And of course, a lot of questions now about whether the momentum that we've been seeing in the U.S. equity markets carries over into December and more importantly into 2025, or have we pulled forward some of those gains already?
I think the momentum continues. We'll probably see a few sputters here and there. I used 2016 as a guide. What we saw there was a relatively strong rally. It peaked in mid-December, but we still finished the year with significant gains from the starting period, which I would view as Election Day. So I don't think we'll see a dissimilar scenario this time. Certainly, the idea of deregulation has unleashed some animal spirits in markets.
It's kind of interesting to see that a lot of those animal spirits seem to be gravitating to the small cap, mid cap, and just that cyclical space. The Russell 2000 outperforming the S&P by a factor of 2 to 1 in this particular month. But this has kind of been the story that's been unfolding for quite some time. People looking for a broadening of this rally beyond the Mag 7 that started off the rally this year into something that's more broader, but more importantly, Kristina, something that's more sustainable. Do you see that rotation as sustainable?
Absolutely. We've been anticipating this rotation for some time now, well before the election. And it was based on our view that we would see the Fed start to ease, we would see an economic reacceleration in 2025, and markets would discount that. So this is playing out. It's probably gotten a nice kicker from the election and expectations around deregulation, and is certainly not being stopped by any kind of concerns around tariffs or restrictive immigration policy. So it's certainly moving ahead, and I think it is very sustainable, although I do think there are certainly risks we can't ignore.
Well, let's talk about some of those risks, because you think about what could upset the apple cart here, and one of the answers I keep getting is maybe the bond market, specifically maybe the long end of the Treasury yield curve. We were having this conversation with Christian Nolting, but it seems like the bond market and the stock market aren't really talking to each other right now. But if you start to see the long end of the Treasury curve rise, 10-year yields maybe go north of 4.5%, maybe approach 5% again, what does this mean for this cyclical rotation and specifically this rally that we're seeing in the small caps?
Well, I certainly think that when you get yields that move that high, if they were to do that, that would put significant pressure on stocks. Although I think the greater pressure would be on tech names and what we consider to be longer duration assets. But the reality is it could be problematic in general. I think the bigger issue is what it makes the government do. At what point does the U.S. government say, you know, we have a problem in terms of fiscal prudence and we need to cut the deficit? We've been here before. The Simpson-Bowles Commission more than a decade ago proposed some really thoughtful ways to help solve, not solve, but at least ameliorate the kind of fiscal deficits we're running. And I don't think a thing was passed by Congress. So we could very well come to a similar situation today. The question becomes, how patient are bond investors? Thus far, they have been, but we know from other countries there are significant fiscal issues going on that could cause some very significant belt tightening, which could create headwinds for the growth picture.
Well, Kristina, to that point, you think about Treasury Secretary pick Scott Bessent, and he has his 3-3-3 policy, of course, inspired by the 3 hours policy. And one pillar of that is that he wants to cut the budget deficit to 3% of GDP by 2028. So the intention is there. As an investor, do you have faith that something like that actually can be accomplished in this political climate?
I think we want to be as optimistic as possible. And certainly, I think the markets will reward any attempts to get there, even if we don't actually see 3% by 2028. I think it's certainly an admirable goal. I do think it's easier said than done. What the Simpson-Bowles Commission found was that there are just so many sacred cows in the U.S. budget. So that while you can, in good faith, propose a number of cuts that seem to make sense, there are a number of lobbying groups and areas of interest that focus on supporting continued spending.
Yeah, and that's a good point, Kristina. I covered Washington for a long time, and I think a lot of people are kind of forgetting just how much power some of these industries have over our lawmakers, and they're not just going to stand idly by as you sort of, I guess, cut into some of those cash cows. It gets to the broader question, though, Kristina, as to whether investors should worry too much about this in the here and now. There's a lot of talk, about this idea of, wait till the policies are passed in Congress, or wait till they're implemented in the White House before you react to them, because there still is so much uncertainty about whether these changes will ever really see the light of day.
I think that's right. You should be aware that they could be on the horizon, but we just don't know what kind of impact. We first of all don't know the scope. We don't know the timing. We don't know the kind of impact they will have. So absolutely, we should continue to invest, stay invested, stay diversified, and just be aware, but to a certain extent have blinders on.
And heading into 2025, you think about the past 2 years, 20% plus gains back to back. It's very, very rare to see that. You wrap it all together and let's set expectations for 2025. What kind of gains could we possibly be looking at?
I think we could certainly see gains between 10 and 20% next year. I think that's very possible given the kind of environment we are set up for. But that assumes that tariffs are not applied, that they're just threatened or are very, very temporarily applied. And that assumes we don't have the kind of restrictive immigration policy that sends 15 to 20 million people away, because I think that could be very problematic for our labor pools, which are already very tight, especially in certain industries.
All right, Kristina, always great to talk to you. Kristina Hooper over at Invesco. Normally I talk to her a little bit later in the day, but I get up early in the morning just for her as we keep an eye on the broader markets, fractionally higher on S&P futures on this shortened trading day, post-holiday trading day. One of the big movers, though, out there, at least on a volume basis, is Super Micro. More than 3.5 million shares swapping hands, and those shares at one point were down 15% in the pre-market. No news crossing the terminal right now, but certainly one to keep an eye on now, down 8%.
Yeah, it's just wild. Of course, there's been a lot of speculation about whether it would be booted out of certain indexes. I believe it was just added to the S&P 500 a couple months ago, and we'll see if it stays in that one, in addition to the NASDAQ 100. But boy, has it been fun to follow this stock.
Absolutely, and we're going to continue to follow that here on Bloomberg Surveillance. We're also following, of course, all the shoppers who are supposed to be out for this Black Friday, all of Bloomberg terminal users. Keep an eye on our Top Live blog. Some great color out there, including some reporter who decided to go to a JCPenney in Newington, New Hampshire, which apparently, according to her, is an island of activity.
Wow.
That's a big talk here. How much are people spending, and more importantly, where are they spending it? Is the department store concept over? Well, Scarlett Fu and I had a chance to catch up with the CEO of Bloomingdale's not too long ago, Olivier Braun, and asked him about the holiday season and the future of the department store model. Take a listen.
The US market is actually the biggest and the most intense market for department stores, so it's very, very exciting for us. As a specialist of department stores, I'm so thrilled to be here. But I think we can do things a little bit differently in the future. You know, I think reinforcing the experience, reinforcing for brands and for customers, I think there's room for improvement for the future. This is what we're working on at Bloomingdale's, is a new strategy.
And of course, you were in Europe and Asia as well, a lot of experience overseas. What have you noticed that's different or perhaps unique about the U.S. consumer and the way they shop and buy versus those in Europe and Asia?
Yeah, I think, first, they're used to go to department store. The share of department store, the importance of department store for the customer is still very, very, very strong. When you compare with Asia, when you compare to Europe, the penetration here is very strong. But I think, that the relationship with the department store and with retail overall is very transactional. And I think we have to bring back more about the storytelling from, our brand partners to the customer. This is all we're working on right now. And this is a perfect illustration of what we're talking about.
Talk about how you do that. You use the word storytelling, and you hear that a lot, particularly in the fashion industry, right. The idea that, you need to give people a reason to spend however much money on that handbag or shoes or whatever, telling a story. So how do you do that in a concept, and more importantly, in a day and age where people are much more transactional? They just want to buy what they want to buy and leave the store, or buy it online and pick it up and go home.
Mm-hmm. When you're buying a bag, you're not just buying a bag, and especially for luxury brands or for premium brands, you're buying a story. You're buying a social marker. You're buying something special that actually is more than just a product. And we have to make sure that actually through the service, through the store experience, we're bringing that to the customer. The second pillar for us is exactly about that. It's about events, about activations in the stores. It's actually, you're not only coming to the store to buy. You're coming to the store because you're going to meet people you like, because you're going to see something different. You're going to live an exciting experience. So this is exactly what we're working on right now. And we want to make it bigger and bigger to reinforce the attractiveness of Bloomingdale's.
How transferable is that to other locations? I mean, this is your flagship location, so of course you go all out for it. But when you go to a store in Texas or California or somewhere else, can you replicate this?
Yeah, that's a very good question, Ramin. Because I think it's all about being Bloomingdale's, and being a chain is actually, it's not only about the flagship. It's actually, we want to be, as Bloomingdale's, the local leader, the local destination. So we have to cascade that to every single store, to every single customer. And the teams are working on it. Of course, it's a little bit different. It has to be relevant locally, but we're doing that in every store.
Given your background in Europe and in Asia, are there plans for any sort of international expansion for Bloomingdale's?
I don't think so. We already have a partner in the Middle East who is performing really well. So Bloomingdale's in Middle East is actually a strong platform. But for now, it's not a priority, because we think that actually we have a lot of opportunities on our domestic market. And we think that we can have actually strong growth in the future in the US, in our domestic market. Building a new platform in a new region is actually very, very challenging. I had a chance to experience that in the past. And honestly, starting from scratch, when you already have mature models and mature department store brand in these regions, is actually very challenging.
What about the mix between your amount of sales that you're getting from your brick and mortar locations and the amount of sales that you're getting from digital online sales?
So right now, we're pretty much in line with actually our peers and competitors right now. So I think the market is around 30%, a third of the sales. But actually, what we observe for the last few years is actually this fantastic growth of online. Well, not jeopardizing the store sales right now.
Is that like a different customer or is it the same customer?
No, actually, we're seeing, so first, online now is our #1 recruiting channel for new customers, but we have this ability to actually transfer our online customers to offline because you have the returns, because you want to actually, book or see what you're going to buy on offline, online. So that's a great continuous experience. I think right now customers are totally channel agnostic. They don't care whether they're shopping online or offline. They want to see a product, they want to experience Bloomingdale's, whatever the platform. So for now, we're talking about online, offline. Tomorrow, it's going to be social shopping. It's going to be, whatever the channel. I think it's really about relating and engaging with the brand.
If you take a step back, and I'm sure in contrast to what you see in Europe and Asia, the department store model has been struggling in the U.S. for a number of years now. What do you think is behind that? Why is the department store model not doing as well in the U.S. as it could be, say, in Asia or Europe?
Yeah, I think, first, the models in Asia and Europe right now are really flagship focused. So I think that's one big difference. And honestly, I think the flagships will have a bright future in the next 10, 20 years. It's not, I think, a problem at all. I think the problem here is managing such a large footprint. And that can be a challenge sometimes. At Bloomingdale's, we have the chance to be in prime locations and prime malls, so very strong locations. We have a limited footprint. So I think we have more opportunities than threats for Bloomingdale's in the future. I really do think that actually the department store model has a bright future, but it has to reinvent itself from the perspective of the customer, but also from our brand partners. We have to be relevant for our brand partners and rethink the model from this point of view.
How about the broader retail landscape overall? Are there too many stores in the U.S. overall?
When you look at just the pure market data, when you look at the overall market is actually slightly growing. The penetration of online is going up. So for sure, the average productivity of the square feet overall in the US is actually slightly decreasing. So yes, there will be probably some losers. It's why you have to challenge yourself and reinvent your model to remain relevant for your customers, but also for your partners.
I have to ask you, when you look at other retailers, and it doesn't necessarily have to be a direct competitor, who do you envy most? Like when you walk into their stores or you shop on their website, who do you just say, wow, they really got it right. I want to try to emulate some of this.
No, first, I really think that actually Bloomingdale's is doing that right. When I discovered the model, I'm sorry to say, but I'd say, no, but it's not the only, it won't be my only answer. But actually, honestly, I was very surprised by the level of engagement of the customer. The relationship that we're building with the customer and with our partners is actually good. And I think we can even do better in the future. But I think there's a lot of source of inspirations from our competitors, but also from other models right now, whether it's in terms of service, in terms of brand mix, in terms of events and activations. There are a lot of inspirations that are in retail and beyond retail. I don't want to give you any names, but I have a lot of source of inspiration actually in the US, but also abroad, which is another thing. I think we should not be too domestic focused because we're going to miss probably some good trends that are happening somewhere in the world.
And you think that maybe what we see abroad in terms of their approach to department stores and just retail overall, you think that's going to be palatable to a U.S. audience?
I'm absolutely convinced about that. I think, we have to bring the best of both worlds, and I think this is where we're going to perform and bring something different for the customer. The customer is ready right now for something different, more inspiring. And this, we can get it from some of the countries or some of the other models in the world.
A conversation that we had with Bloomingdale's CEO Olivier Braun not too long ago. Of course, Bloomingdale's underneath that broader Macy's flagship. Olivier just took over about a year ago. His predecessor, Tony Spring, now running Macy's, the total corporation. And I don't know if you had a chance to get out yesterday to the big Macy's Thanksgiving Day parade. It was raining, though.
Yeah, there was no way I was physically going to go. But I did watch it on the television, and it was cold. It looked really unpleasant.
I know. We normally go. It's our tradition to always go out there every Thanksgiving morning. And we kind of woke up, saw the rain, and we were like, maybe we skip it out.
Did you at least put it on the television?
We did watch it. And we watched Hoda Kotb, who's a national treasure. Al Roker, love him. I don't know. Come on, dude. And then, and who was the other woman? I forgot. Anyway, it was three of them. But anyway, I think it should be us.
I agree.
We should make a bid for
I know.
Well, yeah, why did they get to do it?
I think it's just no one's raised their hand. So this is us officially.
I'm raising my
putting in our
hand
bid.
right now. That's on my bucket list.
Yeah,
is to
Thanksgiving
host
2025.
the Macy's Thanksgiving Day Parade, but only if it's not raining. All right, we're going to set you up here for the week ahead as the music starts to play. This is Bloomberg Surveillance. The opening bell in U.S. equity markets just a little more than 30 minutes away. Futures slightly higher on the day, 0.1% here on the S&P 500. As we give you the diary for the week ahead here on this Friday afternoon, looking ahead to Monday, ISM manufacturing data, plus the S&P Global manufacturing PMIs. We're not a manufacturing economy anymore, but we pay a lot of attention to these numbers.
That's true. We are a services-led economy, but even still, I mean, there is a push to make us more manufacturing heavy. We'll see.
Well, let's take a look at JOLTS data. Remember we used to pay attention to JOLTS data every time, and now, I don't know, not so much. Tuesday, we do get that JOLTS data. Of course, that is going to be the drumbeat to the payrolls, official payrolls data later in the week.
But before we get there, there's even more labor market data that we get.
Really? Like what?
I'm trying to tee you up.
Oh,
ADP.
the ADP, right. Oh, that's right. Oh, I like this.
Yeah.
Segues.
Like
ADP, we get the ADP private payrolls number. So you get JOLTS, we'll get a sense of the job openings. The ADP numbers gives us a sense of the private payrolls. The beige book, which I'm told actually isn't beige, will give you some anecdotal evidence of kind of how people feel in the various
I know
districts.
you read that cover to cover.
I try to, but, you know, it is a little boring.
Yeah.
But there are, sometimes you get some nuggets there and you find out a little bit more kind of underneath the hood of what those headline numbers can't tell you. And then you get to Thursday and we get some more of those headline numbers with those weekly jobless claims.
That's
Who you
true.
got on those numbers, Katie?
I'm excited to see those. It is funny how every payrolls week, and I hope I didn't spoil it, that there's payrolls coming up on Friday, you get this steady drumbeat of labor market data, and none of it matters. Something you hear all the time is never trade on ADP, because often those two numbers don't actually talk to each other.
And that brings us to Friday, the official monthly payroll numbers. Right now, the economist estimates that we have on the terminal, that survey, the median estimates, 200,000 jobs created. Of course, that would be a big improvement from the 12,000 we got the previous month. Of course, that 12,000 very distorted, of course, by storms and a few other factors.
Yeah, when you look at the chart, you basically have to put your hand over that month because it's just so noisy. It was really hard to get anything out of that. But this time around, of course, it's the final payrolls print of the year. I believe, of course, the last one we're obviously going to get before the December Fed meeting. A lot of focus on the headline number, on the rate of unemployment, but also wage growth. Big question marks there, especially as we talk about potential mass deportation next year. That's definitely the thing to watch.
We are expected to see some moderation in that wage growth on both a month-to-month basis and a year-over-year basis. Unemployment rate expected to tick up by about 0.1 of a percentage point to 4.2%, and that becomes the backdrop for a Fed meeting. Remember the Fed? They have one more meeting left this year.
That's true. And it'll be interesting. I think everyone knows that they're going to cut rates. Whether they should, of course, is a hot topic. I'm sure you're having that conversation on The Close all the time.
We do have a lot of hot topic conversations on The Close, and I hope you watch The Close, which is my normal show, by the way. I'm not just doing this for free. We got to promote The Close here every day, 3 to 5. You do a show as well. I believe it's called The Open?
Open Interest, actually. It's 2 words, 9 to 11 a.m. Next time, let's just meet in the middle. We don't have to hang out at 6 a.m.
A lot of great guests on Bloomberg Surveillance next week on Monday when the team is back. Cameron Dawson of New Edge Wealth, Tom Narian over at RBC, Seema Shah of her Principal Asset Management, and Dana Telsey over at the Telsey Advisory Group. Thanks for joining Katie and I today on Bloomberg Surveillance. Happy birthday.